Hi, I'm so glad everybody could join us today.
Welcome. I'm so excited to have everyone join us. So excited that we are here. Good morning. Hello. Welcome to the RIA ESG Summit with Portfolio Summits. My name is Sarah Katrenich. I am the event producer for the RIA series, and thank you for joining us as we kick off our 2021 season. Thank you so much to our sponsors for today, Amundi, Invesco, John Hancock, Nuveen, Schroders, the TIFIN Group, Trillium, and Vanguard. We thank you so much for your appreciation, we appreciate your support and your participation for the event today. We have a full event series for 2021, starting virtual and then hopefully back in person by the end of the year. But up next is March 23rd and 24th, the RIA Advisory and Investments Summit. So join us for that, and we hope to see you throughout the year. Today will be a great day of learning, of community, of networking, and you really need two links for today. The first link is the one that said click to join that you used to get in today, and the second one is in that email, and it'll be in the chat as well, and that's for our breakout networking sessions after each panel. So use both links throughout the day, toggle back and forth to really get the most out of today, to ask your questions, your specific, stump the expert questions of our panelists. If you'd like to receive the CFP credits for the panel today, email paulina@icsummits.com. That's the email that you received through Zoom, or reach out to me at sarah@icsummits.com as well. Without further ado, we have our first panel of the day, ESG SRI Impact Investing 101. We have a fantastic group assembled here this morning. Elizabeth Crawford, Chief Executive Officer of Sendero Wealth Management, is our moderator. We're also happy to have Glen, Yelton, Head of ESG Client Strategies, North America Invesco, Cameron Barsness, Principal at KBBS Financial, Sarah Hersh, Senior ESG Product Manager with Vanguard, and Mark Gordon, Chief Investment Officer and CCO with Wealth Architects. Thank you all very much for being here, and Elizabeth, I will turn it over to you.
Great, thanks, Sarah. I look forward to today's discussion. Our panel prep work has been fascinating, and I think this is a great way to start off this webinar for the entire day. So let me start by just allowing each of our panelists to give a brief introduction of themselves and their experience in this area. Mark, you're first on my screen, so let me start with you.
Oh, hi. Thank you very much, Liz. So my name is Mark Gordon, and I am the Chief Investment Officer for Wealth Architects, which is located in Mountain View, California, Bay Area. And our experience with ESG has been big and growing. ESG and social investing very popular in the Bay Area. And as we've seen the evolution of ESG, as we'll hear about today, we've had more and more clients asking more and more questions and wanting to invest their values.
Thank you. That's great. Glen, you're next on my screen.
Hey, Liz. Thanks. So Glen Yelton, Head of ESG Client Strategies here at Invesco. Been in the ESG space for a little over 20 years now. Whenever I started back in 1999, it was actually still called SRI, so I am old. The gray in the beard gives that away a little bit. But I've spent the first 5 years or so in the RIA space, actually as a partner in an RIA, working with values-driven clients. The next 10 providing ESG data and solutions to RIAs to help them work with clients as they experience that demand increase that Mark was describing. And roughly the past 6 years, I've spent on the other side of the house building products. So building ESG aligned, ESG integrated, and ESG focused products for RIAs to use with their investors and with their clients. So looking forward to today's conversation and talking about ESG, SRI, and Impact Investing 101.
Perfect. Thank you. Sarah, can you tell the audience about yourself?
Sure. Hi, everybody. I'm Sarah Hersh. I'm with Vanguard. I'm a senior ESG product manager, and our team works to support the health of our ESG fund franchise and represent product expertise across asset classes, investment strategies, and product structures. We do that in part by working really closely with our business partners, including our advisory business and the RIA channel within that. And I also get to talk to clients one-on-one, which is a really great part of the job. Before this role, I was working in a different corner of the ESG world at Vanguard in our investment stewardship team. So engaging directly with companies and leading a team of proxy voting analysts.
That's great background as well. Cam, you want to round us out?
Sure. Good morning. My name's Cam. I'm an investment advisor in Seattle, Washington. My firm, Kutcher, Benner, Barsness, and Steven, sounds like a law firm, but we have been doing ESG investing for about 15 years, and I work mostly with our ESG clients, helping them understand how do they want to express what I call those issues and not those values in their portfolio. Throwing lots of ideas at my investment committee of things I want them to research and vet, and thinking about ways that we can kind of push the envelope to make sure we have all the options out there that our clients would want. Not that every client's even going to do anything with it, but knowing what those options are is really important. Also spend a lot of time in the advisor community, helping other advisors figure out how they do this in their practice, that sort of thing. So I'm really passionate about the advisor side too, helping move the needle on ESG.
That's great. Thank you all for the little background to help people get a feel for how you're coming at these conversations, your angle, your passions, your thoughts. I want to start with just a few statistics to, again, kind of set the stage on why this is such a passionate conversation for so many people. Studies have shown that 85% of people are interested in investing in a socially responsible way, whether that's ESG or social restrictions, and we'll get into that. But often they don't know how to express that interest. So that's where we as advisors step in to help them navigate this. 33% of consumers today purchase from a brand because of the company's environmental and social impact. And that's grown from 23% a year prior to this study. That's a big jump. And for all the panelists here, I think they would agree that it's continuing to grow. We've seen record flows into ESG products in the last few years, and the number of products coming to market is incredible. It's growing so quickly. And the UN Global Compact Agreement has almost 17,000 participants worldwide. So this is a big deal. There's a lot to talk about, and I'm afraid we're not going to get to everything that we've talked about in the prep meeting because this is such a great conversation. So please feel free to use the Q&A part in the webinar so that we can get to your questions if they're pertinent, and if not, we'll use them for the networking break and really drill down into more detail. So let's start just talking about SRI, ESG, and impact investing. Do we all have the same idea of what that is? What are they? And I'm going to just toss one to each of you so that we can hear from you. Sarah, would you talk about ESG? What does that mean when we're discussing it?
Yeah, sure. So we really use ESG as an umbrella term to cover many different strategies. They're not mutually exclusive strategies. They can be often used together, and they're both on the product construction side and process. So I know that my fellow panelists are going to go more in depth into some of these, but broadly, I'll say that within ESG, we look at screening. So that can be negative screening to exclude particular business activities or type of conduct, or positive screening to overweight companies that are performing better on certain ESG dimensions. There is ESG integration, which is really about incorporating ESG risks and opportunities alongside traditional financial metrics. That's usually more of an active management process, and it is often because an ESG issue is identified as financially material, and that manager has some kind of edge often in using that process. Then there's impact investing, which I know Cam will talk about. And then finally, as kind of a process overlay, there's investment stewardship, which is that active ownership, thinking about what issues are financially material to a given company or sector that can lead to sustainable long-term value creation. Again, there's not a single right way for an investor, a client, to express the issues or values and meet their financial objectives. It's kind of a menu of options, and regardless of which approach you take, it's really important to understand what the individual client wants and look under the hood to understand the product and the process.
Mark, do you want to give your views on SRI, socially responsible investing?
Sure. Thank you, Liz. The way we view SRI is very consistent with what Sarah said. We sort of view that as old school ESG. As Glenn mentioned, it's been around for many years, a couple of decades. And when we think of socially responsible investing or SRI, it's typically associated with negative screens. No alcohol, tobacco, or firearms, or no fossil fuels, that kind of thing. And it's a very, traditionally has been a limited form of altering portfolios. So what we sort of use the term interchangeably with ESG. What we found is that a lot of clients still think in terms of SRI or social versus ESG. And we just don't like to have the first conversation be, oh no, you're actually using an outdated term. It's just, yes, we do social investing or ESG or values investing. And we find that that helps smooth folks over into a broader conversation about values-based investing.
You bring up a great point. Our industry is so full of jargon. We're used to it. We know what it means, but a client coming in has an idea in their mind, and part of our job is translation, pulling that out and knowing exactly what it is that they're looking for and helping them uncover things that they may not quite know yet, which you point out SRI, you might mean really ESG. Cam, do you want to talk about the impact investing, which is the biggest, hardest beast of all of these to really talk about? It's in a class all of its own.
Well, and it is, but it's like the umbrella term, right? It was the term that the Rockefeller Foundation coined in 2007 that was this idea of sustainable investing. And so it can be both. So I don't want to say that there's one right answer, because if you take away anything from this today, it's that the answers are not black and white and that they run a big spectrum. So impact can be this whole idea, the way we tend to think of it. And I've heard it kind of used so in the industry is that it's that next level where you're willing to possibly give up market return or add illiquidity so that you can have a true impact on whatever that issue is that you're looking for. So in our practice, we see this more in private investing. But certainly you could argue that the public markets have an impact. We'll come back to that later on the ways that you might see impact in the public markets. But usually it's that next step of you maybe could forgo market return. I don't want to say you have to.
Is GameStop an impact investment?
Well, it sure impacted trading yesterday. So it depends on what type of impact you're looking for.
Exactly. Glenn, it's a perfect segue. I've been working with clients since the 90s with SRI as well. Talk to us about how you've seen this evolution in values, in impact, in however you want to describe where we are today. How have we gotten here? What's the evolution of this process?
Yeah, Liz, that's the benefit of having been in this for a couple of decades, is watching that evolution of the field itself. And again, being as old as SRI. There is a background against which this evolution has happened. There's two sort of channels to that. One is data and the evolution of data that's available for investment managers, for advisors to use in conversations with clients and creation of product in that back and forth that we have. SRI, as Mark was pointing out, was very predicated on exclusionary behaviors. It can trace its roots back literally centuries into behaviors by the Quakers related to the slave trade. That's all about business involvement, and that's the type of data that's disclosed in financial statements. It didn't require this separate ecosystem of data collection to look at these types of topics. As demand for that increased as we went through the 90s and into the aughts, there was more mature data sets available, a bit more delineation, a bit more granularity in what we're able to do. ESG emerged roughly around 2003 as a term that was commonly accepted in parallel with an increase in the amount of data that was available. CDP had been pushing for carbon-related data from publicly traded companies. We saw the GRI in its second iteration of the Global Reporting Initiative guiding how companies were disclosing ESG factors. And we saw firms like MSCI and the Sustainalytics predecessors emerge that were capitalizing on this increased disclosure to package data in a way that could be sold. You move forward to Rockefeller's announcement on impact and their push for metrics, and you start seeing a parallel expansion of this data from carbon, from direct company emissions, to secondary effects, to community outcomes, to the broader stakeholder group and a broader data set. So you see that parallel, that evolution of data as we evolve the terms and the nuance on what you can actually act on. The second parallel track, to be very brief, because we're going to explore this a bit more in conversation, is client awareness. As these terms permeated more public discourse that were more commonly referenced, clients felt more empowered to come talk to us as advisors about SRI or ESG or impact. And it might just be a term that's bouncing around in the back of their head that they don't yet know what is, but they're going to come ask about it because they've heard the term. And again, we'll unpack that a little bit more here.
Yeah, you would have to be living under a rock in some way to not have been talking about this topic on some level. Sarah, that brings us to a great point. What are you and Vanguard seeing this area from RIAs and from clients? And Glen's right, we have a lot of information to get through.
I'll be brief.
I'm gonna keep us moving along, but they're great conversations. And I think this is important for all the advisors in the room.
Yeah, absolutely. I mean, in the market overall, there's just been enormous growth. You alluded to it before, a lot more product being launched. We've seen like 300% cumulative growth in AUM over the last 5 years or so, and cash flows last year were just enormous. So that's the market overall. In the RIA space in particular, we're seeing a couple of things. And I think 2020, again, was really a big turning point for that market. Some RIAs have already been quite knowledgeable, sophisticated, and bought into ESG overall, but others are really starting to recognize that at least some knowledge or ability to have sophisticated client conversations is becoming table stakes. So we are seeing some RIAs start to put more money into the market, maybe just dipping their toes in the water without shifting their portfolios entirely. But we also see just more and more conversations about ESG. Between RIA and client, between us and the RIAs. And we really think about putting more structure in place so that the RIAs can have those conversations to help their clients align their unique preferences and their values with their investment portfolios, while, and this is really important, still maintaining focus on the same investment characteristics that they would for any investment, right? So you still need to look at performance, cost, diversification, appropriate role of a particular fund in a portfolio. And it's that balance that RIAs are trying to get more and more knowledgeable about. We say, and I think this has come up before, you have to understand what the particular goal and objective of a client is from a financial standpoint and a social or sustainability standpoint, so that you can match the right product to it. The final point beyond the immediate ESG product conversation, something we're hearing a lot more is an interest in understanding how Vanguard and probably how other asset managers are integrating ESG into their approaches beyond just the ESG labeled product. So we hear a lot of clients wanting to understand how we approach investment stewardship, and that's kind of the ESG approach for all of our internally managed equity funds. How our fixed income group integrates ESG analysis through its credit research process. And they do that to quantify risk exposure and identify potential mispricings. And then finally, we get questions about our active equity, both our quantitative equity, which looks at governance factors, and then our sub-advised active managers that we do expect and oversee their approach to ESG integration and proxy voting, which looks different at every firm, again, because there's no one right answer, but clients really want to understand that we have an appreciation as a firm for how ESG shows up across every different kind of investment approach.
I imagine if you're really working with clients who are passionate about this, you get the question on how you're running your own firm.
Yeah.
Vanguard being so big, I can see how that would be important to people who are truly passionate.
Yeah, it absolutely is. So that's part of the story too. We think a lot about how we support the community, how we support our employees, which we call crew, and we talk often about kind of our environmental commitments, and also a lot about diversity, equity, and inclusion, not surprisingly.
Yeah, you have to live this if you're going to work in this area.
Absolutely.
Mark, clearly you alluded to this, SRI was the first iteration of investing responsibly. Is it still active, or has it been replaced by ESG?
I would say both of those things are true. Practically, I think it has been subsumed by ESG, which we think of as a combination of negative screens, positive screens, tilts and such. So the methodology has certainly become part of it. I don't think it's distinct anymore. But perhaps more important, as I said earlier, it's still active in the minds of clients and potential clients. So we use that one of a couple of ways, especially with new clients. They often have questions, oh, what about alcohol, tobacco, that sort of thing. And then we can lead into something that's, oh, if you're interested in that, are there any other causes or issues that you're passionate about? Conversely, sometimes clients, because they don't realize what it is, they don't bring up the conversation. So we have actually a handful of clients that bring their dogs to office meetings, at least back when we had them. And a couple of clients owned a few rescue greyhounds. And so we're just curious if they were interested in animal rights, and sure enough, they were. And, would you be interested in expressing that value in your investments? Like, oh, we didn't know we could do that. I thought it was just, greenhouse gas and tobacco and such. Just no, let's have that conversation. So I think it's important to be aware of SRI in the minds of clients to open up a conversation rather than a specific different set of policies or investments.
It's a great point. Don't expect the client to bring this to you necessarily. Again, we live in a world of jargon. We live in a world that they don't necessarily understand completely. We have a translation issue oftentimes, and I think that's a wonderful way of engaging them in this topic. Cam, why are we talking about responsible investing? What's important to the client that we are bringing this up?
Yeah, it's a twofold answer, because there's things that are important to the client that they don't know are important to them. And that's our job as advisors. So, from the advisor side, and I don't want to get into the investment piece too much, but, you see a reduction in volatility in some of these. You can see a greater return on investment because of investing this way. And so they don't know to ask those questions, but that's our job to explain why this may benefit them. Because as we all know, we've heard the myth that if you do this, you have to give up return. I mean, I think everybody has heard it. Everybody's shaking their heads on the panel, right? Or don't do this, invest, make as much as you can, and then use charity to do the other. So, our job is to kind of dispel that. But why are clients bringing it up? They're bringing it up because it's in the news. They're bringing up not the word ESG, but they're coming to you and they're seeing what happened in our world in 2020. You think of the December news that 99% of the people that left the workforce were women. They're coming to you because of Black Lives Matter. They're coming to you because everything they're seeing on the nightly news. And those are those words that they're using to express to you that this is important to them, and they want to understand where their money's going. You see now in this space, we have banks that are doing this to invest for good. You have Aspiration Bank and all of these that are going down that front. And so people are asking more and more questions around, what is my money doing? Where is my money going? And I think they're wanting more transparency than we've seen in the past. So for us, one thing that we've done as advisors is we're not waiting for that conversation to come to us. We have a questionnaire that's specific to sustainable investing, talking about kind of the issues that are important to them. And then going to the SRI side of, here's the places I'd like to exclude in my portfolio. And then if I were to do impact investing, here's the places that are really interesting to me. And every client, regardless of whether they've brought this topic up to us, gets that questionnaire. And so as an advisor, you're going to have to drive that conversation to make sure that you're meeting their needs, to make sure that you are the topic du jour at the dinner table when their children are coming home to say, hey mom, hey dad, this is what's going on in my life. Hey, I think this is really important. This is where I'm spending my money. How are you guys doing it? So, as the advisor, don't wait for the client to bring it up, because they're never going to use the words that we use. They're going to do just like Mark talked about, where they bring their dog and you go, oh, hey, I think another place to really understand what's important to a client is looking at their charitable giving on their schedule, on their tax return. We're always looking at that. Where is that money going? And you can get a really good feel for what's important to that client by looking at their charitable dollars. It's a little bit harder now since not everybody is itemizing. So maybe ask them for their 2017 return or 2016 return. But there's lots of ways that you as the advisor need to be the one bringing this up, because they're never going to come and sit down at your desk and say, I'm really interested in ESG investing. It's just not going to happen.
Great point. So many great ways to pull this out. Mark, you started with the Greyhound example. How else do you uncover what the issues are for clients?
Yeah, it really is a conversation that's you have to ask and you have to listen. So we do a values-based planning approach. So we try not to approach clients with, how much money do you have? How much do you want to have when you retire? That sort of thing. It's really what matters to you. And trying to boil things down to things like security or family or charity or animals, things like that. We find that helps sort of form a values foundation, and then we do the financial planning on top of it. That values conversation very easily goes into ESG areas. And we think it's important because those answers are likely to help determine for the advisor what might be an appropriate fund or strategy. Clients that absolutely do not want stock X in their portfolio, you need to know that. If they really only care about, I want to do some good, but I don't know what that means really. So that might open up a lot of possibilities. While if they express very passionate views, that's probably an opportunity to delve into the investment vehicles and the companies that produce them to make certain that those screens and that methodology is consistent with the client's values. And when we're able to do that, pair the product or strategy with the client's values, that's terrific, and everyone's very happy.
I don't know about the audience, but I'm making lots of notes. I do see a lot of questions coming in. Please keep them coming. We'll use them in our networking break. These are great, and I know there's a lot of interest in this topic. Glen, I think going from the values to the conversations with the clients in terms of, this is one of my favorite things we talked about in planning. What's the difference between an ESG conversation and a sales pitch?
Yeah, and Liz, Cam and Mark actually set this up quite well for this part of this. So you can't think about ESG as a hook. It's not how you're bringing somebody in. It's not the used car salesman thing. This is not something that you're going to be just pitching, right? It is, as Mark and Cam were talking about, this is a conversation. This is what, as an advisor, we are really, really driven and empowered to do. You can sit down with the client and you shouldn't be afraid of it. You have these conversations. You don't have to pitch the product, the performance, the returns, all that at the outset here, right? You have the conversation that you would normally have with a client about what's changed, what's important, what's going on in the family with the kids, what have you been doing in your spare time? And there are elements of that, as both Cam and Mark highlighted, there are elements of that feed into a logical extension of a conversation about ESG and SRI. And you have to be authentic about this. If you do it as a sales pitch, that lack of authenticity is problematic. The client is not going to believe that you actually understand where they're coming from and why this is important. And frankly, if you pitch it, the odds are that they're going to go find somebody who actually listens and hears what they're saying, isn't just trying to put them into a strategy. That authenticity also means that there are going to be some clients that maybe you don't have an immediate solution. Mark highlighted the animal rights option here. There is investment options that are focused on animal rights, on animal cruelty, animal testing, et cetera. They're a narrow niche within the broader ESG space. And if somebody's wanting to do a whole portfolio allocation, you have to have the conversation with them about the limitations of what you can actually do in their portfolio versus what they want you to be able to do. And some advisors shy away from that. They don't want to tell the client no, right? They don't want to say, I can't do that. The authentic conversation is, here's what we can do. Here's how we can supplement and amplify what you're doing in this asset allocation part. Maybe it is through giving. Maybe it's through shareholder activism. Maybe we find a company and we vote proxies. As Sarah was pointing out, it's a huge lever that we as investors can use. It takes patience, but we can do that. And that's why never a sales pitch. If you're an advisor on the phone who's thinking, if I put ESG and SRI on my business card, I'm going to see this flood of clients coming in. You're thinking about it wrong. You have to be willing to have the conversation. A quick final note there, Liz, is part of doing that conversation is actually looking internally and seeing, what do I, as an advisor, what am I passionate about? And odds are a lot of your clients, you've sort of drawn clients in that are similar. And some of the passions that you may have personally can be expressed through practice and actually give you a little bit more joy in the job that you have.
I agree. I think if you're in this space, you have to be living it to some degree, whether it's, positive in how you act or exclusions and what things you don't do. But you've got to have looked internally to see how you do this yourself. Cam, there was something you said earlier. It's never going to be perfect. How do you help clients have realistic expectations about this process, about investing like this? And is there a change that clients go through as they get more involved in ESG, in SRI, in impact?
That's a great question. And Glenn, thanks for setting up my answer beautifully. But it's not perfect. And I feel like oftentimes I talk to so many advisors and they feel like they have to be ready to do 100% ESG sustainable portfolio before they even start talking about this with clients. And that's really not the case. We've been doing this for 15 years, and just recently did we get comfortable with 100% model portfolio that was ESG. And so going down the path of like when I hear Mark's comment about animal rights, that's a fantastic thing, but that's not something that I'm comfortable expressing to my clients, because if they say I want that piece, I don't have a fund. We use mutual funds and ETFs. I don't have a fund that my investment committee has done due diligence on that I can then put in front of the client. So as you talk about this, understand that you can start big. One of the places that we have is the Vanguard socially responsible US index fund. And so, that's a great place to start for clients, that you don't have to get really specific on this. And you can say, in the background, you can kind of say to yourself, I'm comfortable in the US and the international space with a couple of these funds, and I'm not ready to go into the EM space in an ESG, or I'm not ready to go into my core bond space with this. Now, there's options in all those spaces, but as an advisor, you can kind of behind the scenes set the steps that you are comfortable going down, so that as a client brings this up, you immediately have some options to present to them. And over time, you're going to learn more and research more and find more, because as soon as you get into this community of ESG investing, there's so much knowledge, there's so much information, and going down that path will really help. But don't not do it because you think you have to do 100% to be perfect at this. What is it? It's perfect is the enemy of good. And so start with good. Start with little bits, tiny little bits of a client's portfolio, and then build on it.
I think that's fantastic advice. I want to drill down a level deeper. Glenn, when we were talking, we talked about environmental concerns, but there may be two sides to the same issue, or a client may think about things very differently, even though it's the same issue, and we may assume they're thinking one way. So what we discussed was a red environmental concern versus a blue environmental concern. Same coin, but very different ways of expressing their views.
Yeah, and that's something I think as advisors, we're subconsciously aware of, right? That different clients we have different conversations with. There's a different framing, and they may have voted differently than we did in the last election. For context, I live in Tennessee. I've owned a Toyota Tacoma for the past 15 years. If I walked into an ESG and environmentally inclined investment shop, there could be a stereotype that's assigned to me whenever I come in that I'm not going to be interested in ESG. But I'm incredibly passionate about the environmental issues, as are a lot of my neighbors. We think about a sustainable future. It's very hard. It's very rare that you're going to find somebody who doesn't think that clean air, clean water, preservation of wild spaces is a good thing. But they may talk about it differently, where one's talking about net zero and climate justice, another's talking about conservation and stewardship. And as advisors, because we do work with a broad swath of clients, we need to know that these terms can be differently used, but mean the same thing. One of the cautions that I've had, or that I've shared with a lot of our RIAs, and Cam and Mark, you guys both have talked about this in your description. There's a lot of times where we do intake forms, where we bring people in, and it's part of the due diligence in bringing a client on board. And reviewing the language that we use and the questions that we ask, just like we would for risk tolerance, we want to make sure we're not unconsciously biasing the outcome the way we've asked the question. We have to do that in a customer or in a client survey that's focused on ESG issues. There's a great book that I recommend quite frequently that was written back in 2004 by a gentleman by the name of George Lakoff. It's called Don't Think of an Elephant. And it's a political primer, actually. It's focused on how progressives can talk to conservatives about things like healthcare, environment, social issues, and social justice. But it does a really good job of highlighting that two individuals can talk about the same topic. If they're using different language, neither of them hear that they're actually in agreement. They think the other person's in opposition. So.
Tell us the name of the book again.
It's Don't Think of an Elephant by George Lakoff.
Something we could probably all use in today's environment. Sarah, we've talked about drilling down, talking to clients, understanding more. As a representative of a firm that works with advisors, how have the product offerings changed and evolved over the years to meet their needs? And what is your team thinking about during this evolution? What are you guys focused on today?
Yeah, great question. Well, as I mentioned, we launched our first ESG product in 2000, but as Glenn pointed out, it wasn't called ESG at the time. So the FTSE Social Index was, more of an SRI product. I would say in the last few years, we've really built out our lineup there. So starting with the equity lineup, we've launched 2 new stock ETFs, an international and a US. And these are also exclusionary or negative screened products. They have changed their screens or they reflect more modern concerns, though, I would say. So whereas we started with the SRI product with everything that Mark is talking about, the traditional sin stocks, tobacco, controversial weapons, now our exclusionary products reflect those same concerns, but they also exclude fossil fuels and they have a diversity screen. And we did that because we found that those were the most important issues to clients broadly. Also, as the ESG data landscape improves, there's probably a better opportunity to identify some of these UN Global Compact violations, which is also an important part of these kinds of products. We do see a role for, even as different approaches evolve, we do see a role for continued negative screening because it enables clients to have these building blocks that are like their traditional products. They're low cost, really broadly diversified, can be used to build a complete portfolio. And then there's always the opportunity to have more specific targeted ESG type funds as the satellites for the portfolio. Within the equity lineup, we also have an active equity product managed by Wellington. This is kind of higher conviction ESG integration, fairly concentrated portfolio where they're looking at companies that have sustainable return on capital and leading stewardship practices. And then most recently, we, in response to client demand and to enable them to build these complete portfolios, we launched our first in the US fixed income ESG ETF. So it's a corporate bond fund that starts from the Bloomberg Barclays US Corporate Bond Index and then takes that down by using some of the same screens as the equity products, reflecting the same issues. And also, again, to the point of having still really strong investment merit in these products, it also has a liquidity filter to enable it to just trade a little bit better. And we found that even in its first few months, it has really tight spreads and it's meeting that client need. So again, this is all reflecting our commitment to long-termism, low cost, continuing to provide the essential building blocks for clients' portfolios. And we know it's a really rapidly evolving space. So we are talking to clients, we're talking to our internal and external sub-advisors, and you can expect like really continued thoughtful product development and evolution in this space, measured as you would expect from Vanguard, because when we launch a product, we're going to have really high conviction in it that we can offer something with a differentiated approach that meets clients' needs.
Wonderful, thank you. Glen, we've talked about kind of living ESG, and something you said when we were preparing for this is that when a client does bring up ESG, does bring up investing with values, you're likely one of the last steps in their lives. They've already decided to live an ESG lifestyle. Will you tell the audience what that means?
Yeah, and I noticed that Mark and Cam were both nodding their heads with that because we've all had this experience. There are a couple of factors here. So most people don't talk to their financial advisor that often. We're sort of like the dentist. They come and see us whenever they have to, or whenever they're feeling some pain. So they're not calling you just for a social visit. But that means that this whole life that they're living, they're giving, the way they're doing purchasing, what their kids are telling them, the topics of discussion around the dinner table, all of those are happening. And there's a dynamic there that ultimately flips a switch in the client's mind. That my kids came home from college and they're talking about the protests that we're involved in. Or I saw this pristine piece of forest that I've driven by for 20 years that's suddenly clear cut. There are these things that prompt them to take those conversations and activities and behaviors that they've had in the rest of their life and come to you as their financial advisor and say, can you help me? And they may not ask directly, but Mark and Cam have pointed out, it's not often that somebody comes in and says, I want to do ESG. They don't do that. What they do is in the conversation, maybe they've driven up in a Tesla, maybe as you're talking about their kids, this came up. There are these indicators that may cue you in to have the conversation, or maybe it's been working on them enough that they come and they say, I'm tired of holding coal companies. Can we do something about that? I'm tired of holding Bank of America, just to pick out a name. No investment implications to this. I'm tired of holding big bank with a long name. Can we do something about this? Those situations, we as advisors have to say, okay, I hear you. And then that conversation we were talking about earlier has to happen. You have to listen. We still have to do due diligence. Cam was pointing out, that's part of the job. You have to find, as an advisor, the funds, the ETFs, the SMAs that you're comfortable with, that you trust the manager to do. Those are still the same strategies that you'd recommend. Do that due diligence. But you are going to be the last person that they talk to this about. If you don't have an authentic conversation with them, it may be the last conversation you have with them, because they'll find somebody who listens.
It's a great point. And just knowing where your comfort level is as an advisor in this conversation is really important. Mentoring with someone, finding someone to help you learn is a great way to grow. So don't limit yourself as you go through this. And I think you'll learn a lot in the summit today. So just keep making notes like I am. And we look forward to talking more in the network, because I think you're going to be able to ask your questions and get real answers for your practice and yourself. We're going to spend the last part of our time on impact investing. And it's probably the one that we could talk the longest about. I think of it still as a little bit undefined, meaning that a client can have a value that they want to express that could be very narrow or could be very broad. The parameters around this are just different. So I want to hear from each of you on how you are addressing this issue with clients and how big of an issue is it? And again, we have nice, clearly defined ways of talking about things, but clients don't. So talk about your experience in general with, I mean, what does it mean to make an impact? And Cam, we'll start with you.
Well, good. Speaking of 2020, it is getting ready for school time out here in Seattle. And so my kindergarten, third grade, and sixth grader are slightly just outside my hidden bedroom door. So if there's noise, I apologize for the everybody's getting ready to go to school moment today. Impact, with clients, this is where if you are going to go to that illiquidity side, or we also think of it in an SMA, and Glen can attest to maybe how annoying our firm is sometimes on due diligence. But if you're going to go down that path with a client, really talking about what that means to them, because what we have found with clients is if we're going to add that extra hurdle of a subscription agreement and conversations around increased risk and illiquidity, and all the disclosures that they have to sign from our compliance side and from the fund side, they want to be very, very pointed in that. And so I can think of, one client who I know super well. I could tell you what their issues are, 1, 2, 3, and 4, and I'm constantly aware of them. We went out and we spent 6 months doing due diligence on 3 different private impact related funds. They were very specific to their top 3, and sat down with them after, I'd pushed the investment committee for a long time. And in the end, they looked at one of them and said, it's too broad. It's not specific enough. Although we like this topic in the second one, it's not our top of mind one. And they said no to the third one. And so our 6 months of due diligence work on this was gone. Now, can we use that work someplace else? Of course. But I think what's important is that as you have these deeper conversations on what is impactful to that client and where some of those more pointed dollars would go if they're not going into the public market space, be ready for them to say no and understand that, in a mutual fund, I may be able to have the conversation with a client of, and I think I said this during our prep, I think of this as like an optometrist when you're putting on the E, S, and the G, that you look at a company or an investment through one lens and you go, okay, yeah, it's good through maybe the environmental lens. And now I'm going to put on the shareholder or the governance lens and go, ooh, maybe I don't like that. And so, I've had those conversations with clients that there's this nuance in the public market and in mutual funds and ETFs that you have to be willing to kind of look through different lenses at a company and see why company X that you really don't like, maybe because you think of them as one thing, is actually doing a good job in this space. And I find with public market investments, clients are willing to have those trade-off and that nuance. But when it's private, that nuance it's sticky. Like, we are here and we are in this silo. And I think that's good, because if you do end up needing to give up market return or have to, divest over some amount of time because a gate comes down on a private fund, then at least it was something that they really felt passionate about and wanted to be in. So I would say, as an advisor, if you are wanting to go down that impact space in the private side, just understand the extra work that goes into it and go into it having had a deeper, here we are about conversations again with clients. But if you're going to go down that private route, it does need to, I feel like, and I'm seeing it with clients, it needs to be really, really targeted. And again, it could be an SMA. We use a private bond SMA, not private. We use an SMA bond, and you can be targeted in there in the issues that you want. And to me, and the way we've talked about it with clients, is that's impactful, because if you're giving your money to certain companies to do projects with, ultimately you're going to see the impact of that investment there. Now, does the client feel like that's impactful? That's kind of up to another conversation to have with them. So if you take away anything from today, take away that you get to have a lot of conversations with a lot of clients, but impact side of it, I think, requires an even deeper one.
I would say it goes back to the statistic of 85% of people are interested, but they just don't know how to express it. And maybe impact we think of more as it's like dating. You might have to bring a couple different ideas to them before they're ready to commit on something. And it's probably not the place to start the conversation.
Exactly. It is not the dip the toe in starting point. I think it's really the place where you've had a couple of years, a couple of meetings of cycles with this client to really get to know them. How do they react to this? How have you seen, market volatility affect them in their ESG versus non-ESG investments? How did they handle those situations? And really, if this client has never done private investing before, I would think twice about having some sort of a true impact private investment be their first one when you're then trying to explain so much nuance and so much complexity to a client. There's also hurdles to it, right? You can't take your smaller client and invest 20,000 or maybe even 50,000 in a private equity impact fund. Your minimums are 250,000, 500,000, $1 million. So it's only going to touch certain client levels anyway.
Very fair. Glen, as somebody who's been in different areas of the industry and having to create products for people to meet their needs, how is Invesco approaching impact investing?
Yeah, Liz, it's a challenge, and I have a feeling when Sarah opines, it's probably going to be a very similar conversation here from Vanguard's perspective. Impact, to Cam's point, is something that requires a lot of due diligence, a lot of research, really a lot of effort to create a true product. There are very superficial impact strategies out in the market now that, frankly, are just misusing the name. It's not really living up to what impact is. And impact should be intentional, it should be measurable, there should be ongoing reporting. Those are minimum requirements for an impact strategy. So here at Invesco, actually 2020 was a great illustration year of how we think about building products in the space overall, particularly as it relates to impact, because after the protests related to George Floyd's death, a lot of clients came to us about this issue, about the issue of racial injustice, about police violence, about income inequality, the whole social construct that was sort of the root here. And that's not something that you can really get through public markets. It's not something that you can just take the S&P 500 and vet out the bad actors, because there aren't any bad actors you can readily identify in this particular topic. And so we sat down to determine and look at what we do and how we could perhaps build an impact strategy that had that intentionality, that would have measurable concepts and that we could report on a regular basis. There were a couple of ideas, Liz, that came out to begin with. One was this idea, let's take a municipal bond strategy. We have a really good team out of Seattle that focuses on this. So a municipal bond strategy that focuses on inner city communities of color, disadvantaged urban schools, and just buy the bonds. That way we're funding infrastructure. The second idea was a private investment concept building on some work we do for a large endowment, focusing on women and minorities, GPs, the VC direct investment. And then the third was, let's build an ETF. So the first one, when we took it into our internal stakeholders, and we have for this particular topic, for the racial inequality, we have a Invesco Black Professionals Network. Take it into our internal stakeholders and say, here's an idea, here's 3 ideas we're thinking about. What the feedback I got on the first one, on the meeting one, was that is absolutely antithetical to what we're talking about. Because what you're doing is you're buying high yield bonds that are forcing these communities, these schools, to borrow money at a higher interest rate, a higher coupon rate, because they fall out of that IG spectrum. Why would you continue this predatory behavior? And I had to step back, because I'm thinking we're building an impact strategy. We have a good approach here, Liz, but the reality is the other side of the dollar on this, it's not the right approach. The ETF one is still something we're working on. We're trying to find data that actually could support building something like that. And yes, there are challenges to data, and this comes back to that evolution in history. Where we're ending up is actually on the private side, like Cam's describing. We'll probably end up bringing out a strategy that is in line with most of our other private offerings that's focused on the IRIS standards of disclosure related to impact. So using an external framework to build out our reporting and the elements that we're going to track. But it's going to be patient capital is what it'll have to be, because day one, it's just allocation. Year one, we've just got a basic progress report. It's year 3, year 5, year 7 in a fund like that you really see tangible outcomes associated with it. So impact investing, it's not just difficult, it's also not immediately gratifying, because these types of allocations take a little bit of time for that seed to grow and flourish and to see the impact that you actually are hoping to get from that allocation. For big firms, harder. There are a lot of good niche players that are very agile that can do this. But as Cam was pointing out, it is about due diligence. And I know Mark knows this from his side too. So that's the Invesco perspective on it right now.
Thank you. We talk about long-term investing. We try and keep people from looking at returns every day, and this just epitomizes it's a long path. You're trying to make change, and so give it the time that it needs, and that's hard to do with a public that's constantly chasing the shiniest object.
Yeah, we just have to go back to GameStop for that one, right?
Yeah. Yeah. Sorry, the dog's barking. That means my nanny's here. Morning stuff, like Cam. Mark, let's talk about how you approach it, because unlike Cam, you guys don't do private. So how do you help people think about making an impact?
Yeah, I think both Cam and Glen spoke about the amount of due diligence involved. And, within the last year or two, we've had questions from clients about about how to have a potential impact on Bay Area childhood hunger, preserving Montana open space, and fostering clean water in Africa. And those are all worthy pursuits, but realistically, we are not going to be able to do the kind of global due diligence for our clients. And if we spend too much time, we may actually be taking away from essentially all of the other clients as well. So it is an issue of resources. What we typically do instead is encourage clients that are interested in impact investing to do so through their charitable dollars. And we found that has two potential advantages. One is philosophically, clients feel like it makes sense. The charity is supposed to have an impact on something that's outside them. It's not done for investment purposes. So it's like, oh, okay, that seems like a pretty good marriage of capital plus intent. And also, if the investment doesn't work out well, that's not terrible. And if it does, then great, you get to make more of a charitable contribution. What it also allows us to do is make referrals or suggest clients be in contact with local community foundations and smaller folks like that. So for example, in Montana or in Bay Area, people that are dealing with this stuff every day. And that way, we're sort of trying to steer our clients toward folks that really are experts in impact and can help them channel their dollars where they're likely to have the most satisfactory experience.
Thank you. I think that's an approach that probably a lot of people can latch on to and say, okay, I can make that step as a first step in thinking about how can you bring impact into your world. You guys, we could go on and on about this. Like I said, I know there's a ton of conversation to have. Let's move over into the networking room, and then we can have continued conversations. We can get to the questions that are in the chat and really dive down more. Sarah, do you want to give us just final thought right before we move over?
Yeah, sure. I mean, I agree with a lot of the challenges that everyone has raised about impact investing. And, we think about it as being targeting financial and social objectives that are measurable alongside each other. In the public space, which we haven't talked quite as much about, there are probably opportunities for talented managers to add value because the space is so undefined and it requires just a lot of company by company due diligence. We don't offer any impact products today because it is a really high bar, but through our manager oversight and search process, we're always constantly meeting with managers who are offering different strategies, and we're overseeing where the market might go through that approach. Like any other strategy, if we can find a world-class manager who can create a great product that we feel confident in, then that's something that we explore.
Thank you. Sarah, I'm going to turn it over to you. I could talk all day to this group.
This is fantastic. Thank you so much, all of you. Thank you for braving the elements inside your houses getting ready for the morning. But I appreciate your comments. We learned a ton, and I'm really excited to hear some of the Q&A in the networking meeting. So join us there. The meeting ID and the password are up if prompted. Also in the chat is the link. So feel free to copy that, exit out of the webinar, and then join the next meeting. Also on Zoom, our panelists will meet us there. But thank you so much. We will come back to this same link, this same webinar space at 12 p.m. Eastern Time for building an ESG strategy or practice. And until then, I hope to see you again. Thank you so much all, and we'll see you in the networking. Hello, everyone. Thank you for joining us for the next panel, Building an ESG Strategy or Practice. I'm going to call our speakers up to the stage. We'll get started in about 3 minutes, and then we will hear from them. Hi, Michael. How are you? Hi, Elizabeth.
Hi there.
Hi, Gary. Hi, Karen.
Hi, Sarah. Can you hear me?
Yep,
Sarah, can you hear me?
Great.
I can.
Fantastic. Hi, everybody.
Hi.
Michael, do you want to test your sound?
Gary, you're on mute.
Testing 1, 2, 3.
Perfect. Loud and clear.
Awesome.
Right. Karen, your background looks great.
Thank you.
How is everyone doing today?
Very good. The sun is out, even though it's cold.
Having fun in e-learning.
Exactly.
That's great.
Thank you. Thank you.
Elizabeth, you already got a shout out from Nancy Metzger.
Thanks, Nancy. Woohoo.
Greatest portfolio manager.
Aw, that's fantastic.
All right, well, it is 12 noon, so we will go ahead and get started. Building an ESG strategy or practice. Panelists discuss the challenges of creating an infrastructure to support ESG SRI investing, tailored technologies, client communication strategies, and direct due diligence, how that can help to avoid greenwashing and provide the impact that you actually want. So we have Graeme Campbell, Managing Director of Barrett Asset Management, as our moderator today, Karen Wawrzaszek, Principal and Senior Director, Sullivan, Bruyette, Speros, and Blaney, Gary Hirschberg, CEO and founding member of Aaron Wealth Advisors, Michael Winnick, Chief Revenue Officer of the TIFIN Group, and Elizabeth Levy, Portfolio Manager and Research Analyst from Trillium Asset Management. Thank you all very much for being with us today, and over to you.
Great. Thank you, Sarah. And I just want to add a quick thank you to Portfolio Summits for hosting and arranging this virtual call. And thank you to our accomplished panelists. I know we all potentially have different things going on at the moment, and we understand any interruptions we may have. So thank you, everyone. I just wanted to add, and again, thank you, Sarah, for saying this, through prepping through this panel, in discussing these topics about tailored technologies, client communication strategies, and due diligence, what I found is we're still learning how really more about what every firm does and how we approach this. And so through learning more about our firms and our different approaches, I hope we answer some of these questions for the listeners, and just recognize everyone's doing things a little differently. And that's what we're here to learn to do. So I'm delighted to be here to help amplify our voices and support our impact and share about our roles as advisors and our practices. I thought what we could do to start is everyone give a little bit more background on themselves, on their firms, their roles, and where they are focused on, and then we'll get into a little bit of a deeper dive. To start, just to give insight, I'm a partner and wealth advisor at Barrett Asset Management, a $2.5 billion independent RIA firm based in New York City. I'm here in a New York City apartment working remotely. We work with high net worth clients. We have an 80-year rich legacy firm. And what I partly why I joined was to help create initiatives to help augment what we're doing for clients. And of course, in the past 5 years, we've gotten much more demand for ESG focus, but that wasn't around 80 years ago for us specifically. So we are actually in the early innings of developing infrastructure and process. And I learned just as much as everyone in terms of listeners, and I hope this is valuable for folks. So if I could, I'm going to pass it along, and I'll ask Karen, then Elizabeth, then Gary and Michael to introduce yourselves and your firms. I know, Sarah, you provided a good background here. I also wanted to add, for anyone who wasn't there in the first panel this morning, there was a great background provided around the definitions of ESG, comparing some things to impact, and also approaches to the public space and the private space. So that is a foundation that's been set. So Karen, if I could pass it to you to give a background about your firm and so forth. Thank you.
Thank you, Graeme. It's an honor to be here today, and any chance I get to help educate, raise awareness, and move our field forward, I'm happy to do so. My name is Karen Wawrzaszek, and I'm a principal and senior director for SBSB Financial Advisors, which is easier to say than Sullivan, Bruyette, Speros, and Blaney. And so in that role, I lead our financial planning practice, as well as head up our impact investment in ESG strategies and platform. I come to this work with about 20 years of experience, and of that 15 really dedicated to mission-oriented and values-aligned investing. Have spent the bulk of the past 2 decades in the family office and ultra high net worth space, and really helping to connect behavioral finance and kind of family motivations to how they would like to see their investments play out in the community and in support of their lives and their legacy. And so bringing best practices to our firm and helping the other advisors and teams that serve our clients identify with how to put ESG practices and impact practices in motion. So that's a quick summary. And we are a Washington, D.C. based firm, privately held, of about 66 employees at about $5 billion under management. So thank you.
Thank you, Elizabeth. Sorry, guys, ladies first.
Hi, everyone. I'm happy to be with you all today. Thanks for having me. So I'll talk a little bit about Trillium and then about myself. So for those of you that aren't familiar with Trillium, we were one of the founding investors in the ESG and SRI movement. We were founded in 1982, and we have always had a sole focus on sustainable investing, which we're now calling ESG. But we were really founded based on the beliefs of using the capital markets to improve society in the world. We are also a B Corp, which means that by charter, we take into consideration sustainability considerations, our employees, our clients in the world. We're an asset manager, so we have intermediated business, institutional business, as well as wealth management for private clients, such as high net worth and nonprofits. We also run a number of mutual funds, including several that are sub-advised with John Hancock. And again, these are all ESG strategies. And we are about 4 billion assets under management. There's about 40 of us. And this summer we were acquired by Perpetual Limited, which is an Australian financial services firm. So my role, I am an equities portfolio manager. I've been with Trillium for 9 years as of next week, to be exact. I manage a few of our equity strategies, including working on our sub-advised mutual funds for John Hancock, as well as I am a research analyst looking at the power space. Trillium is mostly based in Boston. We also have offices in Portland, Oregon, and San Francisco, and I am sitting here in my kindergartner's bedroom while she is elsewhere today.
Gary, and then Michael. Oh, can't hear you, Gary.
That's because I was on mute. Sorry. Thanks for having me. My name's Gary Hirschberg. I'm the CEO at Aaron Wealth Advisors, an RIA based in Chicago. This is where I'm sitting right now. If you hear a little background noise, you might know where your kindergartner are. I know where my eight-year-old is right here. So forgive me. I have been in wealth management my entire professional career. I started at Goldman Sachs. I was there for almost 15 years as a private wealth advisor. My wife and I have always personally been involved in ESG investing. It's been a sole focus of ours, although we service all types of clients, ultra high net worth individuals mostly, some institutions. As of our latest SEC filing, last year we had about 840 million under advisement. Currently we have about 11 employees and 4 advisors, including some that just joined us recently, which we're excited about. And most of our philosophy is to build excellent discretionary portfolio managed accounts with a specialty in philanthropy and of course ESG, which is something that we're really focused on at Hersh Wealth.
Fantastic. And I think Michael brings a really unique lens and view for all of us to hear, specifically related to technology. And thank you, Michael, too, to your firm for helping sponsor this event. So go for it, Michael.
You bet, Graeme. Thanks so much. Michael Winnick, coming to you from Boulder, Colorado, and I am Chief Revenue Officer with the TIFIN Group. We are a fintech studio, which means we're in the business of creating, launching, and growing fintech companies. I've been in the industry for 25 plus years. I was at Schwab for 4 years prior to TIFIN. I was at Russell Investments for 11 years prior to that, running distribution for Russell, and created one of the first camps in the industry with the fintech I started prior to that. What I would say quickly about TIFIN and ESG is that we are uber focused on personalization. And when we think about ESG and we think about catering to individuals who want to invest with the ESG focus, we believe that taking a personalized approach is necessary to achieve their objectives. And if you look at the platforms and companies that we're creating and developing, they are all lending themselves to creating that personalized connectivity between the investor and their wealth manager. So I'll leave it at that for now, and I'm looking forward to the dialogue.
And Michael, if you don't mind, just for scope of reach, I think you mentioned, how many locations do you have? How many employees do you have working on the projects you're working on?
Yeah, you know, we're upwards of around 100, including a wholly owned subsidiary in India, where the majority of our engineers are located. The majority of our associates are here in Boulder. We do have folks in the New York tri-state area and a few other spots around the country.
Great, thank you. You know, so clearly for listeners, right, we have firms here ranging from nearly $1 billion of assets under management to $5 billion with assets under management, and Michael with many folks helping support advisors like ourselves. So thank you for that background. So to dive a little bit deeper into your practices relative to kind of quote infrastructure building, you know, I'd like everyone to try to think about any stories they have, but their firm specifically and your own personal professional approach to your practice. I think it helps clarify for folks, oh, you're doing it this way, you're doing it this way. Karen, when we prepared a little bit here, you've mentioned how you approach your work with clients, I think with a planning lens as well as holistic approach, if you can touch on that on the individual side, and then we'll move on to Elizabeth. Go ahead.
Yeah, that'd be great. And also the approach, really, the kind of the client segment, I think also covers not just the individual that I focus on, but I call institutional light. So endowment, nonprofit that also have similarly aligned missions and goals that I have found the approach to work just as well. We do a couple of things. So we're a financial planning led firm. And so my passion is deeply rooted in behavioral finance. I think people kind of express how they want to be through their choices around money. So money behavior is very much, I think, central to why we're here today and what we're talking about. In doing that, I have discovered over the years that there's a common thread that is kind of as families are deciding about connections and values that they share, how they can share in the investment experience as well. And creating then at our firm a set of, we'll say, core and then bespoke solutions to addressing kind of the impact-oriented ESG themes, where there's a multi-strategy approach to the core part of that, But then there is a bias oftentimes, depending on the family, depending on the organization's particular goals, that you can bring into into that portfolio that really, I think, advances what the family's goals are at the end of the day. And all trying to achieve what I think we've now set out in the UN Sustainable Development Goals of 17 with a variety of milestones that we're all learning about and putting in motion. And the key objective that I think has made it really hard, Graeme, in this space is how can you scale what appears to be a lot of snowflakes, right? And so you have portfolio construction issues, and so it's really about finding these common threads. Where are there intersections that you can scale, you can put together and apply to different circumstances, but then still customize around that in a bespoke way. And so that's how I've come in to really attach to the behavioral finance component of it. And at the end of the day, really try to map, this approach then is achieving this variety of goals, and whether they are among the 1 in 17, or if I have several clients, and in particular a large foundation where there's a racial equity goal, where there is an environmental goal, but you can't just be working toward that in ignorance of everything else that cascades from that. And so that's been kind of central to my approach, the values-led approach. I hope that's helpful.
Yeah, sounds like a very personalized, customized approach, and you're speaking to the challenge of repeatability.
Yeah.
With the customized. Elizabeth, do you mind, given Trillium's background and tenure in the space and your role as portfolio manager, could you speak to your approach, how your firm looks at this, given your expertise, and pull in some of the tools you use to do so?
Sure, thanks. So I would say, Trillium has a variety of different services that we offer to different types of clients, depending on how they're accessing us, ranging from wealth management to simply portfolio management, such as our mutual funds. But what is really at the core of what we're doing, I would say, is a two-pronged approach to our ESG foundation. One would be on the investment side, the ESG integration we do, which is partially using data that's already out there and partially our own data. So I had mentioned in the prep that we do begin with MSCI data. And I mean data, not scores. So we don't just import scores and use them. We really tear apart the underlying data in the MSCI approach to use it ourselves. And then we roll up our sleeves and do some digging ourselves and come up with some of our own data and our own scoring systems. So that's on the ESG integration side into building the portfolio. But then once our portfolios are built, I think the other thing that Trillium is really known for is our shareholder advocacy program, which is so important to our firm, but also to our clients. They really love knowing that the money, that their money that we're managing for them is being used to further some of their goals. So I've just got a few quick examples. I could talk about this for a long time because they are so interesting. But these are just a few examples from the most recent few quarters on a variety of different topics. So for example, about climate change, we pressured Costco and they have pledged to release a new climate strategy. And then in a very different vein, but also still on climate, we had filed a shareholder proposal at Bank of America, urging them to become really the last US bank to commit to not financing for oil and gas exploration in the Arctic. And at the end of last year, they agreed to do so. So they are no longer financing those types of projects. So those are both within climate, but they're very different. And that is the kind of approach that we take. And then there's a wide variety of other topics that we do, but one that I thought might particularly resonate is around racial justice, which has become so important to everyone over the last few months, but particularly our clients. So a company we all know, Starbucks. Trillium has been dialoguing with Starbucks since 2017 around diversity and inclusion, and we kept at it this year. And recently, they agreed to provide full 3 years of full data on their workforce composition with regards to gender and racial composition of their workforce. And they've set targets for both their corporate workers as well as their retail workers for BIPOC representation, which was really great to see. And we're glad to be doing that type of work. So I think that both of those aspects, both the portfolio construction as well as the shareholder advocacy, are so important to our clients, and they love hearing those types of stories.
And I'll just add for folks, listeners, Elizabeth, I was able to take a peek at Trillium's kind of white paper area, tremendous. So for what that's worth of client communications, I can see your firm's offering so much depth on these types of things. Thanks for that. And Gary, do you mind giving some thoughts on your approach? And I know you mentioned uniquely in advisor committees that you formed and helped along the way.
Sure. Our approach, as it is with any client, not just ESG related, is completely customized to their needs as a broad family office structure. Our goal was to be a specialist in the ESG space. And for those clients who wanted to come to us and wanted a 100% ESG oriented portfolio across their asset allocation, that we be able to provide that. It certainly wasn't something that happened overnight. It took a lot of due diligence and research and structure along with our investment committee to put together an appropriate allocation, but we can now tell our clients that we can build that for them. And we continue to increase our access and ability. But one of the places that we did early on is I realized is like we have our investment committee, and that's where our core is to be able to find great investments for our clients. But we also needed a lens from an ESG perspective, but not just from investors, and how we could further that cause in general as a firm. So I was fortunate enough to have about 8 volunteers to join us in an impact board, advisory board, in which we meet with on a regular basis as we are exploring different themes in the ESG, particularly particular products, not from is this a good investment, but from, is this truly impact? Is this truly ESG, or is this greenwashing, or is this not something that we should be looking at? An example I can give you is that at Aaron, we created our own charter school bond fund with a partner, Tortoise. It's completely designed just for Aaron Wealth clients. It invests only in charter school areas. But before we did that, we actually went to our impact board and said, is this, first and foremost, do we consider this impact? And is it an issue at all that there might be different political opinions on it? Right. And it was a very robust conversation about it. And we ultimately, all the board, including those that had a difference of opinion on charter schools, said, this is great because it does help a certain population clearly in that area. So we launched that fund, and that was very successful. So I'm very thankful for their volunteer capacity, and it's just a fun way, an impactful way for them also to interact with other like-minded people from all across the spectrum.
And Gary, if you don't mind me asking, could you tell us more? How do you have those people in? Are they just part of your network? You ask them? How do you form those committees? Just volunteer time once a year?
Because of my wife and I particularly have been very focused in ESG personally, and have been involved philanthropically across lots of people in our lives. We're very fortunate. I knew a number of these folks had an avid interest in investing based on their values. So an example. We have a Presbyterian minister who happened to be my roommate at Georgetown back when I was in college, but he's back in Chicago, and he sat on the national SRI committee for the Presbyterian movement, for many years. So we would have lots of robust conversation about that. And on the flip side, we have an attorney from Indianapolis who runs a sustainable blackberry farm, in which he reaches out to local inmates actually to provide them with opportunities to work on that farm. Most people don't even know that, but that's something that we got to know each other well, and she's amazing. Just to give you some examples, our most recent addition actually is a professor from Vanderbilt, where I went, who's been doing ESG research, probably, Elizabeth, since your firm started as well. So he's very, very avid, Professor Mark Cohen, and he was a long time ago a professor of mine as well. So just to give you examples of the folks that were put together in one place.
Fantastic. So some touch on values, some touch on process and integration. Michael, do you mind commenting how your solutions might be helping us sort through this in the landscape of things?
Yeah, absolutely. And I think I'll come back to, where Karen kicked us off. And that is the challenge for wealth managers to cater to the individual needs of investors and their desire to invest within, ESG orientation. And, how do you do that as a wealth manager in a scalable way, right? And the only way to accomplish that is by having really good technology. And, I think ESG is emblematic of what's going on in our industry broadly, in that, our industry is a little bit behind others when it comes to the notion of a personalized experience. And if you think about the first, trip around the barn with ESG, it was all about packaged products, and asset managers were wondering, why those products were not getting the traction that they were hoping for. And the reason is that, one investment solution does not cater to all when it comes to ESG. And again, it just lends itself to the notion of taking a personalized approach, and technology is the way to incorporate that into your business. And so that starts with understanding the investor and having a methodology to truly understand what their ESG objectives are, toward how you go about creating unique portfolios and doing that in a leveraged fashion. And then finally, how do you communicate with an investor so that you are communicating with them about what matters to them and what's invested in their portfolio. So those are all what we think are super important capabilities for wealth managers. And, that's what we're setting out to try to help with.
If I could ask everyone to go around the room just briefly, just because I think infrastructure is important. And Elizabeth, you touched on this. Thank you. Karen, Elizabeth, and Gary, other technologies you're using to do your diligence? Are you, for example, Elizabeth mentioned MSCI, Sustainalytics. What programs are you using in addition to perhaps your own metrics? And do you use your own proprietary scores to measure this? How are you communicating it? So Karen, if you don't mind starting, and Elizabeth, you can reiterate, and Gary.
Yeah, no, that's a good question, because as Michael was speaking, the challenge kind of extends also because the field is so new. So as an investment advisor that is an open architecture, the luxury of that is that we can look outbound quite extensively for services, for reports, for data from either managers we've approved and have on our platform, and or other, and all the ones you listed, anything kind of produced through, I look at US SIF, I look at Sustainalytics, I look at MSCI, Bloomberg. There's a variety of services we pull together. Everyone's familiar also with Just Capital, and kind of a different new way to think about ranking. That's been very curious to me as we've kind of considered new ideas like that kind of disrupt legacy exclusionary ranking of the old days, and getting more into, okay, how do we think about the engagement part? A lot of the work that Elizabeth was talking about as a kind of, proprietary portfolio manager. And so we have the luxury through our managers and through reporting services to piece together. The downside of that too is a little bit of the making that consumable to the investors, right? That aren't known so specifically to each of these issues. So the reliance on you to interpret what some of the progress of these investments are and how they're having toward their goals is the other part, because you have in my world, you're representing multiple generations in a family, foundations that are constructed of board members with different ideas of what success looks like when you construct these portfolios. So putting together data in a way that says, okay, I'm helping arrive at an answer that demonstrates we are adding value, or we are not, to the goals that you've outlined, and especially in the multi-generational family and family office space where have exclusively lived. That's not just one family stakeholder that you're trying to demonstrate diligence to on the funds that you've put together, the external managers you put together, and ranking. So it's not a simple ranking. It ends up being, okay, is this idea gaining traction? Are we making progress on this particular theme? And that's how we approach it. And that's what gets back to kind of finding that common ground, where you might have the bespoke pieces that have a separate measure, but the common ground, that core part in the middle, which represent a lot of the capital in this country through our US large corporations, all moving ahead in this way. That's making it a little bit more straightforward through the reporting services.
Yeah, that's helpful. I would just add, we take a very customized approach, but the challenge is repeating that process of different generations coming for different ways to communicate their own value system or what they care about.
Because that's one of the problems, is that, and my final kind of point on that is that if you're your buyer, your investment buyer, ESG buyer is really a family representing 3 or 4 people that have a stake in that capital pool, one measure might be really important to one, and you can excel at creating that measure, and it may mean nothing to the other 3. And trying to figure out, okay, how do I represent and add value in the aggregate? And I think the industry is struggling deeply with this. So I do think it's in constant innovation, and I'm always just looking for new ways, quite honestly. But fortunately, in an open architecture, I'm not trying to reinvent the wheel, I'm trying to figure out, so that we can scale, what is best in class, and how can I bring that?
And Gary, do you mind commenting on any idea you have there? And then I wanted to reiterate one of Elizabeth's comments earlier, and then get to Michael.
Yeah, I mean, I think our firm's approach to kind of due diligence in the ESG space is really, it first and foremost is rooted in our normal investment due diligence process. It has to be. We can't start with ESG. It has to be make it through the robust, if it's a private aspect, really digging into the numbers and talking to the management team and see if it passes muster. So then we go on to the impact side of it, if it's appropriate in that space. We have lots of great partners, and that's why we're a dynasty firm. They do focus heavily as well on ESG, and we have a lot of due diligence resources and framework. We try to stay away from scoring. I just don't think it's great in any way. And then there's the human element of it. Again, I go back to, why do we have this advisory board? Why do we talk to the management team? And one of the fundamentals is, particularly in a private side, if they're not reporting already on their impact that they claim to be having, they don't even make it past round 1. You got to be reporting. They have to be showing us that they're already doing it. We're not going to teach them. Otherwise, the concern is that they're using the hot dot, if you will, of ESG just to get money and raise it and charge fees. They're not really truly doing impact. So those are kind of the metrics we use. We're always open to the newest and best fintech framework. On the public equity side, we partner heavily with Ethic, which is a great technology, an asset manager, but a technology that is highly customizable for clients who want to really invest and drill down into the data based on their own personal values, which fits well with our model, of course. It's customization. So as an example.
Elizabeth, do you mind just reiterating for folks, you use data, but then you put your own, Trillium has its own process. Can you comment on that, just because you've been around longer than most of us?
Yeah, and I'm really excited to hear what Gary just said. So as I said, we take the MSCI data and then we use it. So we take it apart and reconstruct it and do other things with it. So, as a fund manager, a strategy manager, it would be pretty easy for me to try to, for example, game my MSCI rating by just using MSCI, right? And making sure that I look good according to MSCI. But of course, that's not what we do. So I'm glad to hear, Gary sort of putting out some of those points. So we do think it's really important to communicate with our clients. So we do have impact reports for each of our strategies that we keep on our website. Anybody can access them at any time, because one of the struggles that certainly I, as a portfolio manager, have felt sometimes, when you have sustainability insights into a particular company and you might own it for a particular reason, but it doesn't look great on Sustainalytics or MSCI, and then you are being held to account for a score that they produced, which is not necessarily exactly what you're trying to do with your portfolio. As Karen was saying, there's different people that value different things. There's different aspects of sustainability, different ways we might think about things than the rating agencies. So the way that we try to deal with that is through our impact reports and trying to explain what we do, as well as all of the other information we put out, like the shareholder advocacy highlights I mentioned, trying to explain why and how we're doing what we do.
It sounds like just a very strong educational component is still needed. As I think we can read in many reports today, the metrics are hard for folks to really fully grasp. So a lot of work to do. Fantastic question came in, and I hope, Michael, you can help answer this. How can RIA firms filter the universe of technology platforms to consider for scaling their business to optimal target market? So intersection of target markets and, what we're talking about. How do you get there to scale your business? Any thoughts?
Lots of thoughts. Let me, if I can, first just comment quickly on the prior conversation, because I think it was super interesting. And
please.
There was some comments made about, you have, multiple family members with disparate interests who are all part of one capital pool. And, how do you deal with that? How do you handle that? And, I think what's super interesting to think about is not only ESG and the capital pool from an investing perspective, but then how do you also tie to how people want to give? Right. And one of the interesting things in our industry is that the way that people give and the nonprofits and the charities to which they give don't always align with how they're invested. Right. And someone may be environmentally focused from a giving perspective, but then if you look at how their foundation or their investment accounts are invested, they're investing, in fossil fuels. Right. And they don't align. And so that's a very interesting disconnect that we believe exists in our industry that is solvable. And then when you add on having, again, disparate interests of family members who are all participating in, one pool of capital that's being used to give, that problem gets even more complicated. And once again, good technology solutions are the only way to solve those problems. So those are just some thoughts on the prior dialogue. Listen, I mean, we obviously believe that technology is the answer when it comes to wealth managers, financial advisors, incorporating ESG into their practices. And I think the question that was posed is, well, how do you find out about these technology platforms? And there's some really good, resources out there. Michael Kitsis does an excellent job of trying to summarize, the technologies that are out there, categorize them into the different, areas of our business that they are addressing and that they're solving. And I think those type of resources are a really good place to start. And, just do your due diligence, right? Spend the time to really uncover how that technology works and how it can, benefit your business. And again, and I'll just keep saying the same thing, we just think that the industry is moving towards a personalized approach. And if technology is not helping you get there in a scalable way, I would encourage you to think long and hard about that. But again, just to answer the question, there's some really good resources out there that are trying to help advisors sift their way through the various fintech solutions available in the marketplace.
That might be a great area for Q&A too, to what are those areas, what other sources do we know about? Gary, you mentioned one, I'm going to look that up as well. I guess I'd ask, different lengths of time in this area, just getting a sense of early innings, mid innings, late innings from your own perspectives. I mean, there's still so much work to be done. And Elizabeth, you've had sort of experience there. I guess I'd ask each of you, do you see challenges ahead in your own businesses so folks can reflect themselves? Karen. Go ahead. You're
Yeah,
nodding.
it's interesting. So kind of two answers. I think we are in early innings, very early innings on the mainstream question that we've all had over the years. Are we creating things that meet the needs of the broader population? I think we're a little further ahead in the construction of ideas, like what Trillium has done. So I think that's further along. So actually making things available, but it's this bridge of that's kind of missing. How do we actually then scale that, get that to interested investment consumers in a way that isn't entirely a bunch of customized snowflake portfolios? That's really hard. I agree with Michael. That's where we're really, really new in trying to understand, how do we actually use technology in a way that then bridges this gap? It's the big information gap. It's the gap that, family offices are interesting and unique, for example, have been, I would say, early funders, early adopters, in my experience, in kind of the mission-oriented investment ideas and themes. And now in this past year, this is where I've had this kind of aha moment of how much the retail or mass affluent really doesn't understand yet about the space and how they participate in it. And that's where I think technology can help us. And then kind of like we all say in this space, democratize the access to this. So that bridge is kind of missing. And I think that's where we're very, very new in it. And that's the job on people like me to think about how we educate, how do we actually motivate someone to take action. I do a lot of work around in the nonprofit space as well. And those motivators are very different when you're giving away money as to when you're investing money. Even if the outcome is, I don't want to do harm in the community, the approach is very different. And what we're still trying to figure out is we still have an investment group that want to package those two ideas together. And I think it's, you may be arriving at the same outcome and not doing harm, but your expectation of the investment dollar is extraordinarily different than it is of the incubate the gift dollar and allow that to be lost in some way. And that's been kind of our social contract, right? We have all kind of lived decades and decades with this in mind. And so this is going to be the new place, is how do we actually apply the same rigor so that we aren't doing harm, so that the mass affluent participate in the way, because those are inbound questions I'm getting, and they're generational. I'm getting different questions from senior generation family members to younger generation emerging professional family members that are really clear about what they want to see in the world. So I would say the kind of investment, the client base and accessing, we're very new. And I would say from the product creation side, we're a little further along, and it's bridging that gap.
Yeah, I'll just comment on your comment. We've found sometimes we just need to have 20-minute educational platform on what are these different areas, how do we define it, and then let folks digest that, and then come back around to say, what is it that you think you care about based on what you just heard? Yeah. I mean, it's sometimes a push. Because we've got a few questions that I think are fantastic, we can touch on them. I'm going to jump right to Michael. Specific TIFIN technology solution being used to deliver to wealth advisors. Can you touch on specifics?
Well, I can give a commercial for a few of our platforms, which I'm reluctant to do. But listen, we have one platform that is really great at helping advisors to get to know investors at a much deeper level, right? And our industry has been one that has historically profiled individuals on one dimension, which has been risk. And we believe that there are multiple dimensions that we can measure people on to truly understand what's important to them. What they're passionate about is one of those dimensions. And we believe that there's a better way to initiate the dialogue between the wealth manager and the investor to, again, better understand the investor, build a deeper understanding between the wealth manager and the investor, and then ultimately a deeper tie between the investor and their portfolio through realizing, what we've learned is important to that individual through core satellite portfolios, where the satellite and thematic investments align with what, again, is important to that individual. So that's one example. Another example on the tail end is, communicating in a digital world with investors in a personalized fashion, right? And so just not throwing out onto your LinkedIn, an economic update, right? Putting something out there that aligns with your value prop and that positions the wealth manager as a thought leader in an area that aligns with their value prop and that is important to their clients. And technology enables and allows wealth managers to do that. And, one of our platforms facilitates that as well. So I'll stop there. I could keep going, but there's a lot of great solutions out there. And, happy to help in any way we can.
Great. I'm going to pivot to Gary quickly and then back to Elizabeth on these two questions. I think they're great and hopefully we can continue after this panel. Gary, how did you craft the governance relationship between your impact board and the rest of the board of directors? A committee of the board? Is it an advisory board with formal authority or liability? Can you talk about how long it's been in place, pros and cons so far? I think this is hitting on kind of infrastructure compliance and governance at the same time.
So our committees are all volunteer. They're not compensated. They're not involved in governance outside of course, we use our investment committee, in terms of compliance aspects. The advisory board, impact advisory board is all volunteer. It's just to help us think through topics related to ESG and to have more robust conversations with the potential technologies, strategies, investment opportunities, et cetera, as well as provide a forum for these particular folks to talk through, leave their day jobs and talk through things that are really important for them. But they're all volunteers. So the control remains within Aaron Wealth. So we have an entire investment team with our CIO running our processes and due diligence. That's completely separate from the advisory side of things. So we keep that aspect in check. And because we're fully customized and discretionary, we don't have models or forms, et cetera, in the ESG space. It's really driven by the client and what the client would like to do, which is different, I know, from other RIAs, potentially, and other providers where they're looking for more scalability and then they have more compliance issues associated around the ESG space. For us, it's all driven by the client, not us.
Great, thank you for answering that. I don't know where our end here is, but Elizabeth, a question that came in, can you give an example of how you deconstruct data from MSCI and other providers for applications across client-specific portfolios?
Sure, and I'll try to do that briefly because I know we're running out of time. So, when you get an MSCI report, for example, on a specific company, the top line is the score. So, a company might be a BBB or what have you. So one of the things that we focus on doing is not just using that score, but looking at the data that goes into that score. And MSCI in particular, their ratings are really a combination of their risk model and their assessment of companies' performance. So we try to dig below to try to find out the data that's going into their performance assessment as well as the performance assessment, so we can disaggregate that from the risk model that they layer on top of it, because we are bringing our own values and beliefs into what we think are the material ESG aspects. So when we're analyzing a company, we are not using that top level score. And this is across, all of our portfolios. We're looking, of course, at all of the companies in our portfolios. So we're looking at the data that's feeding into it. And that's what I mean by we're pulling apart that score, in that we're digging in and we are doing things with their data to come up with our own assessment rather than just taking what we've been given, if that's helpful. And we do similar things with, for example, data from the CDP. We might take company responses from that and feed that into our own analysis.
Thank you. Yeah, I just wanted to add for folks, if you get a chance, and Elizabeth, you actually tipped me off on this, if you check out BlackRock and Larry Fink's recent comments, they talk about a survey they've done, and there's a letter to CEOs. I mean, this movement is here to stay. And they surveyed 425 investors in 27 countries, estimating 25 trillion of assets under management in question. And just if everyone has time to read it, bottom line is this thing's here to stay, but the measurements are still tricky, and it suggests we're still in early innings given the challenges around the data measurements and tools and how we advisors deploy them. So I just leave that with that thought. I see you, Sarah. Should we come
Yep,
to a
thank
close?
you so
Okay.
much. Yeah. But you all will join us for the 1:30 p.m. networking break. So we are moving on to a next panel, but these fine panelists will join us again for that. And we look forward to chatting with you. Thank you so much for everything in this panel.
Thank you.
Yes.
Thank you.
Now we will
Thanks so much.
Thank you, everybody.
We will turn to making an impact in the global markets. I'm going to call these fine panelists up, and we will get started in just a minute. Hello, Sarahs. Hi, Michelle. How are you?
I'm doing well. Hi, Sarah. Can you hear me?
I can.
Wonderful.
Perfect. Hi, Donald. How are you?
Good. How are you guys doing? Can you guys hear me okay?
Yes, we can.
Michelle, thank you for your help earlier in the week. I had like a panic attack there for a moment, and I went back and took my notes, and I'm like, oh, I think we're good.
You're gonna be great, Don, and I appreciate the dialogue.
Thank you for your help.
Hi, Jeff. How are you?
I'm good. How are you?
Good. Excited. I think we are all here, so we'll go ahead and get started. Making an impact in the global markets, like I mentioned, panelists discuss how ESG selections are functioning in international markets, how changing policies, specifically with regard to climate change considerations, provide opportunities for clients and reward for thinking outside of the US. So we're so excited to have you all here. Michelle Soufan, Senior Client Advisor from TFC Financial Management, Sarah Rumpf, Director of Investment Research from BBR Partners, Jeff Gitterman, Co-Founder, Gitterman Wealth Management, Donald Casagnini, Chief Investment Officer, Mercer Advisors, and Sarah Bratton-Hughes, Head of Sustainability, North America, Schroders. So thank you all very much for joining us today. I will turn it over to Michelle to moderate.
Great. Thank you, Sarah. Hi, and good afternoon to everyone. My name is Michelle Soufan, and I'm a Senior Client Advisor with TFC Financial. We're based here in snowy Boston, Massachusetts today. I'm excited to join you all as the panel moderator and introduce my esteemed colleagues this afternoon as we continue our discussion around ESG. Thank you to Portfolio Summits and to our sponsors and all of you that joined us this afternoon. This is going to be a great dialogue. Let's start by going around the screen so everyone can give a quick introduction and then we'll dive in. Jeff, why don't we start with you?
Thank you so much. If you hear screaming in the background, it's my 4-month-old who found his pterodactyl voice this week, so I apologize, but I can't talk him into being quiet at this point. So I'm Jeff Gitterman of Gitterman Wealth Management, and our focus is really twofold. One, we do have clients directly, mostly New Jersey educators is our specialty for the last 30 years. Then we're also an outsourced CIO to other firms where we provide ESG, sustainable investing, and climate adaptation strategies for them to deliver to their end clients with true customization in a UMA format. Then we also run conferences at the United Nations on ESG, the SDGs, the whole soup of the sustainable development world. And I host the Impact Show on FinTech TV. That's it.
Wonderful. And we've got two Sarahs, so I'm gonna use the full names here. Sarah Bratton-Hughes, why don't you go next, please?
Great, thank you. And I'm so happy to be here today. I am Sarah Bratton-Hughes from Schroders. Schroders is a 200-year-old, $650 billion asset manager headquartered out of London. We have been sustainable investing for over 2 decades here at Schroders. I'm part of a broader global team. We are 100% integrated. So baseline standard here is that you have to be taking account sustainability when you're investing on behalf of our clients, as we see ourselves as long-term stewards of our clients' capital. And for us, I always say we started this 20 years ago. Because we thought it would lead to better risk-adjusted returns over time for our clients. And we still firmly, and by the investment we put into it, believe in that today.
Wonderful. Don, why don't you take next, please?
Yes, thank you. My name is Don Calcagni. I'm Chief Investment Officer with Mercer Advisors. Mercer Advisors is a national wealth management firm. We currently have about $27 billion in assets under management and about 50 offices across the United States. We were originally founded in 1985, and we have always been a very socially conscious organization. We're originally headquartered in Santa Barbara, California. We've recently, several years ago, moved our headquarters to Denver, Colorado. And specific to ESG, where we saw a real opportunity in this space was when we look across the product landscape, we see a lot of great product out there from many of the folks that we're listening to here on the panel today, but really trying to find a way to bridge the conversation with actual private clients. And so that's really where we feel that we've added some value in the ESG space.
Wonderful. And Sarah, last but not least, Sarah Rump.
Hi, I'm Sarah Rump. I am a director of the investment research team here at BBR Partners. We're a multifamily office based in New York and with offices in San Francisco, Chicago, Boston, and Austin. And we manage roughly $20 billion on behalf of about 160 families. And so really trying to look like a single family office for each one of those families that can include developing customized asset allocations for each of them, working with them on things like wealth management, tax planning, trust and estate planning. But it's a really highly customized process for each of them. And so a big piece of that is incorporating their values into how we manage their portfolios and how we invest their portfolios. You know, I'd say it's been a growing area of focus both for us and our families really over the last 10 years. And I think it's something that we expect to continue to grow more just in terms of the investable universe and demand from our families.
Wonderful. Thank you. I think we see that trend as well. And earlier today, we've heard from a couple different panels, really good discussions about defining ESG, SRI, as well as building strategies in that space. So we'd like to take what we've heard, build on that, and expand the scope of the conversation into global markets. So the global marketplace, very broad, diverse. We're talking about developing markets versus developed and developing, and across specific countries. So I'd like to pose our first question, Sarah Rump, to you, and then hear from some other panelists. What are your thoughts on some key similarities and differences in how ESG investing is manifesting itself across managers in different regions?
Yeah, it's a great question. And, you know, I think it's a bit of a broad generalization, what I'm about to say, but we look across all asset classes, we look across all geographies on behalf of our clients. And I do think you see some pretty big differences across different geographies. You know, I'd say from our experience, the managers that we work with in Europe are probably the furthest ahead in terms of incorporating ESG policies into how they invest. You know, one of our long short equity funds that focuses on Europe, it's not an ESG strategy by mandate, but that's been a part of their investment process for over 5 years. They recently hired a head of sustainability. So even though they can go anywhere in Europe in their long short equity strategy, you know, ESG is a core component of how they invest their portfolios and how they look at companies. I think in the US, you know, it's something that we're seeing develop pretty rapidly, honestly, across strategies. But I think there is a ways to go. And I think just hearing from people like us, the managers know that it's a growing area of importance and something that they need to dedicate resources to. And then I'd say, you know, on the emerging market side, that's probably where there is the most room for growth. You know, I think in a lot of cases, it's just not necessarily something that they've heard the demand for. Maybe there aren't resources enough to be allocated towards ESG in emerging markets. But I think that's where we see the biggest room for growth and room for improvement, and hopefully something that we'll see continue to ramp up.
Great. That's helpful. The other Sarah Bratton-Hughes, anything you want to add to that or expand on what you're seeing, similarities, differences, and between the regions?
Yeah, so I think I have a firsthand seat at the similarities and differences between regions because I am the sole American on my team versus the bulk of my team being in London. And we actually have individuals on the ground in Asia as well. And I think having that global we have our global presence, but actually having people on the ground and sitting in the investment offices, our major investment hubs globally, has really helped to facilitate and accelerate ESG integration amongst our investment teams. And the way we're structured, and I always say this, it's not an outsourced ESG function. So our team is centrally resourced, and we're giving that specialist knowledge, research, and developing proprietary tools that help our investment analysts on the ground globally, but giving them the flexibility to interpret those tools because they're who actually know the investments the best. So that's my really eloquent way of saying we're not in an ivory tower in London saying what you can invest in and what you can't invest in. It is not a bolt on to the investment process, it's embedded. What I think if I take a step back from an asset manager side and I look at how we're investing in companies, I think the biggest difference for us tends to be data. And I know we'll probably talk about it, and I know Jeff will definitely talk about it because he's a data junkie like I am, is that when you go to the emerging markets, you don't have the same amount of data. Particularly when we're building out our tools and our toolkit. So some of our analysis becomes less quantitative and more qualitative. We're utilizing the same stakeholder frameworks, but you have the data. But what I always say is, although you may not have the data and the formalization, some of our best investments and our most sustainable companies are in emerging markets. So one of the largest positions in our sustainable fund is a Kenyan telecom company. And what they do in terms of their mobile payment platforms, how they promote, train, and hire women, how they really feel like they're giving a national service and not price gouging their customers, has made it one of the best performing companies over time, and one of the most sustainable business models. But they don't have the IR department to put out all of these policies and tick the box and get that high score from others. So I think from that perspective, it's sometimes we see the data really, as you go into emerging markets, you have to roll up your sleeves a little more, but I think that's opportunity. That's alpha, right?
Yeah, no, it's fair. And what type of questions are you asking managers to sort of get at that data or get, try to incorporate that weaker data into your models, Sarah?
So I would say it's not a one size fits all approach because we're focused on materiality. So we take a stakeholder approach rather than just doing E, S, and G. We're focused on how companies are managing their stakeholders over time. And it really depends on what industries and sectors you're in. It's, I'll take Schroders, I'll turn the mirror on ourselves because that's the easiest. We're an asset manager. We better be, we have our employees are a huge part of human capital. That is a massive part of our business model. Our customers, we have a fiduciary responsibility to be delivering the returns. And we operate in 32 countries globally, so we better be treating the regulators properly. Those are our most material stakeholders. But if you look at something like a mining company or an airline, they're very different in terms of what their material stakeholders would be. So it's really engaging with companies, and it's not just understanding that they have the policy, it's also if they have the oversight, right, as well, and how that fills up to the board level. Because if they just, policy is one thing and disclosure is one thing, but our companies really actually acting responsibly and sustainably over time.
Right. No, that makes a lot of sense. Jeff, do you want to chime in since Sarah alluded to your thoughts? We have a couple thoughts to add on this topic.
I mean, the European taxonomy, I think, will now kind of merge over to the US since we have a change in administration. So we're certainly looking to that. There's been, relationships now with SASB and GRI where they're merging together to create more global materiality maps. So I think we're going to see a deluge of data enhancement, hopefully. We've already seen a deluge of data, but I think we're going to see a narrowing of scope of where is that data actually applicable? How do we assign it through materiality maps that hopefully SASB and GRI will become kind of the leaders on that as they have been in Europe for sure. And then I think what we're going to see, which is going to be an avalanche really of information, is more physical and transition climate risk data that is going to start hitting from all sides. And I think Aladdin, was the first brush of this because they announced in December that they were adding physical and transition risk data to Aladdin, which I think governs risk on about $80 trillion in assets. So between that and MSCI's new climate reporting and carbon delta being acquired, I just think that's going to be the leading edge of ESG inclusion and data. And right behind that, I think is going to be social inequality based on the year that we've just had. So I think we're in for a lot of convergence of what data is important to the process, and how do advisors adjust to that and adapt to that is a difficult road, but that'll be the road we'll be on for the next few years.
Got it. Got it. And Don, from a consulting perspective, maybe you can share a little bit about your thoughts, and well as what's still missing from managers and what we hope we're going to see in some of these trends that Jeff alluded to here.
Yeah, I mean, and just a preliminary observation. Just yesterday I was talking to the CIO of a large, very recognizable North American-based asset manager, and when he was asked about ESG, the way that he framed it as a preference item for end investors, right? And that's very different. Several weeks ago, I was speaking to a manager in London, to echo what the two Sarahs have shared with us. They view ESG through the prism of risk. And so when you talk to them, they're talking about ESG risks. When you hear Jeff speak, he's talking about ESG risks and climate change risks. And so I do think there's a difference in perception between how US asset managers talk about ESG and certainly European managers. And that's not lost on advisors, that's not lost on clients. And while having lots of, and this gets to really the heart of your question, Michelle, what's really missing in the space for higher net worth investors, they're looking for the ability to customize. They have strong views, they want to see those values manifested in their portfolios. So not to take away from all the great product development that we see out there in the ETF and mutual fund space, but within the SMA space, having the capability to implement negative screens to remove certain sectors or specific companies, and tilt towards specific impact areas, perhaps climate solutions or something like that. So we need more there. That's what's missing. We need more that is UMA compatible, that can fit into a sandbox with other pieces of a broader asset allocation, so that RIA firms don't need to open a plethora of investment accounts just to implement a single allocation. So we need to really bridge the gap between how we speak about ESG, how we can customize ESG, and then get it incorporated into the technology stack that advisory firms use with their clients. Got it.
That makes a lot of sense. I think we heard some of those similar sentiments on the previous panel. So common struggle here. Let's take a few minutes and dive into the E, the S versus the G. And Sarah Rumpf, you work with 160 families. What are you hearing in terms of the wants and needs? And are there particular areas of interest within ESG in the focus, or is it more broad-based?
Yeah, it's a great question. And I'd say it's a little of all of the above. It is really interesting. Given our focus on hyper customization of portfolios, and the fact that every family is different, each family has a different reason that they're focused on ESG. Maybe one is particularly concerned about climate change, and another just doesn't want to do bad things with their investments. It really does vary from client to client in terms of where their area of focus or interest is. And so I think that creates a really interesting challenge for us, because it means that we have to cast a really wide net in terms of what we're looking for. If we find a strategy that emphasizes renewable energy, for example, that's great for the people that are particularly focused on climate change, but it may not satisfy people that are more focused on the social aspect of ESG. I think, like Don mentioned, being able to screen in SMAs is a really useful tool in terms of going to the most extreme levels of customization. But I think that's more challenging when you're thinking about things like hedge funds or private equity. And so we really try to cast a wide net, find things that we think will satisfy the interests of most of our clients, and have kind of a as big of a toolbox as possible to work with those clients and help them out.
Great. That's really helpful. And let's start with E. We got a question from the audience, and it dovetails with something we talked about in our prep call here for Jeff. Let's dive into this. Talk a little bit about your thoughts on the state of the capital markets response to climate risk, and can you define transition versus physical climate risk and elaborate there on what you're doing with your firm and what you're seeing in the industry?
Yeah, for sure. So, in transition risk, we're looking at price on carbon or stranded asset risk. So what's going to happen if we start taxing companies on the amount of carbon emissions that they're generating, as opposed to physical risk, which is just, dealing with more floods, more droughts, more extreme heat, extreme weather, and, certainly food scarcity and issues that are stemming from the physical changes of climate change, and also migration patterns that are occurring because of that. And that risk, because of the delay of dealing with the carbon emissions that we're facing, is going to really be the primary driver of the cost of the capital markets. We'll also hopefully see a carbon tax at some point, or carbon pricing, that will start to affect companies that are bad actors in the marketplace and having to pay for those costs. But when you look at the capital markets in general, and you start to look at even what extreme weather events have cost the capital markets and the marketplace, the expectations of most people today is that climate change will be, like a 5x versus 2008 financial crisis, which is traumatizing. I mean, you're talking about, 5-6% hit to global GDP because of physical climate risk. And that has to be addressed. And what advisors don't understand, and most investors don't understand, is that behind the scenes right now, asset managers like Schroders and data managers like MSCI and Sustainalytics and rating agencies are all starting to price in that risk by affecting their ratings on it. And once you can measure something, then you can manage it. But once you can measure something, it also causes repricing in the marketplace. So as of now, every home in the US has a flood score from Street Easy. So if you're going out to buy a home, it might not be road behavior today, but within a year, you'll look on Street Easy and say, okay, there's two homes in the same neighborhood, and one has a horrible flood score and one has a good flood score. And all of a sudden, that starts affecting pricing in the marketplace. And what we have, unfortunately, and I'll try to keep this brief, is a failure of imagination to understand that the way we've lived for the last 10,000 years with a stable climate is changing rapidly. And because we have no frame of reference for that, we're unable to actually think through the problems that will drive. But the repricing is about to hit no matter what. I mean, you can get every single QSIP in the United States right now, you can get a VAR score, a value at risk score, of how much that municipal bond will be affected by physical climate change and transition risk. And if that data is available, once managers start using that, the investors in the marketplace are going to get priced out of that. So right now, you could kind of de-risk your portfolio to a lot of this data being available, but not currently priced. So you could de-risk your portfolio for free right now, almost. Where in the next 12 to 18 months, you're going to have to pay to de-risk your portfolio because the ratings are going to become public. Aladdin scores are going to start being embedded into risk management of large investors and institutional investors, and the investor is going to get left behind on it. So it's critical that they start looking at these facts now.
Absolutely, absolutely. That's really helpful. And Sarah Bratton-Hughes, maybe we can switch over to the S and talk a little bit about the social and social justice space.
Yeah, I just want to add something on to Jeff's comment there really quick when he talked about institutional investors already thinking about this. So we have been, we've had a carbon value at risk model for a number of years now. And if we think about on the corporate side, what we're doing is basically stress testing a company's profitability if carbon was taxed at $100 a ton, because that was the price that is the price we believe carbon has to be priced at globally in order to meet the goals of Paris. I have seen, and this is just anecdotally, but it hits at the heart of what Jeff has said. I work a lot, again, with some larger institutional big plans here in the US, and one of them said, oh, price our portfolio at we said, okay, we can look at your portfolio, but we price it at $100 a ton. And this was probably like 3 or 4 months ago, and they laughed at us and said, no, that's not realistic. Price it at $50 a ton when you stress test our portfolio. They came back to me on Friday and said, oh no, we need you to price it at $125 a ton, because that's what our state EPA is coming out talking about, what the price of carbon is going to be in the specific state. You go up to Canada, most people miss this, but up in Canada, we missed it because of all the fun we were having here in the US. In December, they established by 2030, they will have a nationwide carbon price in Canada of $170 a ton. So we are really starting to see, as Jeff said right now, you can see, and we've done sort of studies on this, like what would it cost to buy insurance on your portfolio right now? It is very cheap to go in and make that. But as we continue to see these portions unfold, and not to harp on this as well, and I know we'll get to regulation, but if you look through the executive orders, actually buried in one of them by Biden was he has established a committee to come out with the social cost of carbon, the social cost of NOx, so nitrous oxide, and the social cost of methane. And that is all by January 2022. So this stuff is coming fast. These prices are coming fast, they're coming furious, and they're going to impact valuations very, very quickly. So I just to sort of bring it full circle, and Jeff has heard me talk about 2019 was the year of Greta, 2020 was the year of all of the social issues. Have we swung back, and 2021 is the year of net zero? Time will tell. I still think we have a lot in terms of the S here, in terms of social issues that and some unintended consequences of COVID that we're going to continue to see social up the ladder as well.
Absolutely. Maybe Don, you can chime in too to bring us home on the E, S versus G, and see what your world is showing us now across managers.
Yeah, no, absolutely. And when I just look at client demand, I think what we find is there's a lot of clients. When we look at the E versus the S versus the G, the E is hands down the most popular. That is what clients are mostly concerned about. Tends to be always at the top of their list. Even after last year with all the social unrest in the United States, and it's not to say that those are mutually exclusive. It's just that if you had to rank, the E is definitely at the top. I love everything that I'm learning so much, and I'm taking notes here just listening to my fellow panelists, and I'm really excited to hear about the pricing of carbon in Canada and things like that. I think this kind of gets back to the prior question, what's missing is part of the challenge, and I mean this with all due respect to our end consumers, our market, the scientific literacy in the United States is not the greatest. And so we have to find ways to bridge that communication gap with reporting. Right now, and I know we have the MSCI ESG ratings, and the prior panel was talking about those at length, but digging a little deeper and showing, for example, what is the carbon footprint of a portfolio? How many cars were taken off of the road effectively by virtue of the portfolio that you're in? So I think we have to find ways, I hate to say this, but for lack of a better term, but to gamify the information so that consumers can better digest it and connect A with B. If we can't do that, I'm afraid that this is a conversation where it's going to remain esoteric, and it'll just be sort of ESG nerds like us who are talking about it. So I keep trying to think, how can we broaden that conversation and bring in a bigger audience?
Absolutely. Yeah. And a question came in here, I think that sort of ties that, Don, into another topic here for Sarah Rumpf. How is the active engagement at the manager level and the companies they're investing in being realized and understood by the advisor and their clients? So I think this kind of brings together a couple of things we've been discussing this afternoon so far.
Yeah, no, it's a great question. And it really varies. I think I think that's one of the big challenges, additionally, that I think faces advisors like us trying to parse through all of the different managers and what they're doing to incorporate this into their process. There isn't a one size fits all policy. There isn't a one size fits all way of analyzing ESG risks or ESG opportunities. And so unfortunately, there's no, I think, easy way to kind of look across managers and say, we think their policy is really strong versus we think their policy is greenwashing. I think, unfortunately, it just takes some elbow grease and in the weeds due diligence to really understand, how actively they're engaging with companies, how real their policy is, what data they're using. But I think that makes sense, right? And I think that's the opportunity for managers too, right? It's the same thing. Fundamental analysis looks different for every active manager, and so ESG analysis may look different for every active manager, and those that have the best process, that use the best data and go the furthest to get data, will have an informational advantage and should perform better. And I think we believe in that in active management in general, and think that is true and makes sense as it relates to ESG analysis as well.
Absolutely. Yeah, it's really helpful, really insightful. I'd like to switch over and dive a little bit into the linkage between government policy and investment opportunities and talk a little bit about the policy side. Jeff, maybe you can share a little bit about your thinking on how the new administration will affect sustainable investing both here in the US and abroad.
Certainly in the US, I think we started to see it towards the end of last year, where you saw sustainable infrastructure companies and renewable stocks all start to skyrocket. And I mean, I think that trend will definitely continue with the split Senate. Tax policies, economic policies are going to be difficult, even though we have, on the Democrats, they have the one vote win, but you still are going to have a difficult time passing a lot of, health policies and economic and tax policies. But what you do tend to have much more bipartisan support on is sustainable infrastructure, renewable energy, and climate initiatives. And I've sat in on a number of Republican-led climate initiatives of congressmen and senators. So there are a lot of people on that side of the House that are getting pressure from their states, which are, true red states, to address climate issues. I mean, certainly farmers in the Midwest are seeing the ravages of climate change, probably more than most people in the US are even addressing it or seeing it right now. So I think we'll see that kind of go full steam ahead. And, unfortunately, 2020, again, tied for the warmest year on record. And the number of, storms in the Atlantic were the worst. And what I think people need to understand is we tied for the worst year on record with no El Nino. So the last worst year on record, I believe, was 2016, where we had an El Nino effect, which makes the ocean currents warmer. In 2020, we had the warmest year on record with no El Nino. So, we broke record temperatures in California for the hottest temperatures globally. So I think you'll see, now that we've joined the Paris Accord, you'll see a lot of initiatives, cross between us and Europe on addressing climate issues from a regulation standpoint. And I think it bodes really well for the people that are on, this panel today, because we're kind of at the forefront of at least making sure our clients are in line for gaining from investments in these types of investments as policy and regulation and the climate all start pushing this agenda. But also de-risking our clients' portfolios as well. So there's both, there's opportunity and there's risk in anything. In this case, if you're looking at it from both sides, there's a way to gain opportunity and avoid risk at this point.
Wonderful. And Sarah Bratton Hughes, in our prep call, we started just talking about a little bit of what Jeff already alluded to here, and we got a question specifically to you as well. I want to address both right now. Let's talk a little bit about Biden's executive order that was just signed as it relates to climate change here in the US. And then we'd love your perspective on how soon the EU ESG regulatory environment will expand to include the US as well as Asia and emerging markets, and where you think that the trend bubbling here and how Europe and the US and Asia can be coming together on this.
Yes, I feel like my life is becoming dominated by policy, and I'm not sure that's where I ever pictured myself, but there's a lot going on. And I think we saw the swath of executive orders that had happened on day one. And I think we were a lot of people were ready for a lot of them, whether it was rejoining Paris, whether it was this focus on climate. I highlighted when I dug into it, I was surprised to see the executive order targeting the social cost of carbon, methane, and nitrous oxide. It got very specific around that in terms of climate. But I don't think any of us were very surprised by the climate ones, given the sort of dream team that he had put together with John Kerry and Gina McCarthy, and then, you know, Brian Deese on his National Economic Council. So I think, you know, his actions, he had, I always say actions speak louder than words. He had a lot of words during the campaign. His actions prior to him being sworn in all signaled a certain direction. I'd say the one I was most surprised about actually was when they put the regulatory freeze on, and particularly as you think about that for the DOL's ruling, their fiduciary duty and their pecuniary duty rule on ERISA and ESG plans. I was hopeful, obviously with my career and how I firmly believe that being a millennial, not retiring anytime soon, and I want my retirement money to take into account these issues over time. I was really hopeful on a professional and personal level that this would come through, or we'd see a non-enforcement, but I was very surprised given everything that the administration had to deal with, that this was such a focus and upfront. So surprised to the upside on that. Shifting over to the regulatory environment as a whole, I think we lived in a very different bubble here in the US the past 4 years when we talk about regulatory environment around ESG and ESG standards. What we had seen in the rest of the world was this explosive amount of regulation. So MSCI actually did a study on this. In 2017, there were maybe 100 or so policies or regulatory regimes about ESG and sustainable investing that exploded to over 220 just 2 years later, with the majority, the bulk, almost all of them, almost all, in favor and favorable of sustainable finance. None more famous than the EU Sustainable Finance Initiative. And make no mistake, those of you that haven't heard of it, the EU is not just putting their flag in the ground and saying, we are going to be the leader for sustainable investing. They're actually actively within that. The next phase of it is going to be driving capital away from quote unquote brown or dirty industries into clean industries. So they are talk about capital moving, shifting. And we talk about sustainability from a risk. I see the capital movement as a massive opportunity. Also, many people just say, oh, that's an EU issue. That is not an EU issue at all. So every single asset manager that has over 500 employees that sells in Europe. So that's not just Schroders because we're headquartered, well, we're not in the EU anymore, but not just Schroders, but it's BlackRock, it's Fidelity, it's JP Morgan, it's T. Rowe, it's every big US name has to abide by these rules in Europe. And what a lot of them are getting in the first part, and which is SDFR, is issues around disclosure to stop some of the greenwashing that we've seen happen in the market. And what do I mean by greenwashing? Active managers like us saying, putting a green label on their fund. But when all of my colleagues in wealth management were doing their due diligence and dug under and picked up the hood and went underneath, they weren't doing anything really special on sustainability. So that's what the first part of these initiatives are to cut down on. I think from a Schroders perspective and somebody who has seen the amount of, well, we applaud the product, the innovation that's happened out there. We've also seen the people that are doing it from a marketing perspective. We do welcome some of this regulation on greenwashing and ensuring that the end client is really getting what they're saying they're getting. Because if there's a bubble or a scandal here, it's not good for any of us. So what do I think is going to happen over here? I think the policy is already in the movement. I tend to think it's unlikely that the US will just blindly adopt European policy. I don't think that's in our nature as Americans to go and do that. And if you look at how policy is developed over there, I mean, the document itself is developed in Brussels by the politicians, and then it's handed off to the regulators over here. I think we're looking at doing it a little bit in the opposite direction, and I could anticipate over time the SEC coming out and saying, something similar to the 80-20 naming conventions and some sort of rubber stamp on it. I also think the CFA initiative has potentially some legs. And why do I think that is? They're the only one with the global remit when they're looking out to potentially from a fund disclosure perspective. And I think about how GIPS has evolved over time. It's not mandatory for us asset managers to abide by GIPS, but every single one of our clients asks if we have GIPS compliant performance. So I could see that happening as we continue to name our funds from a sustainable perspective. But I do think regulation is here to stay. And here in the US, we're up for some policy around sustainable investing. Like you said, Michelle, the first session was all about what do you mean when you say this, that, or the other thing. I think it would do us some well as an industry to have some of these terminologies or have some gates around some of these terminologies and have them defined. So buckle up is what I say to policy.
That's really helpful, Sarah. I saw both Don and Sarah Rumpf nodding as you were speaking and as Jeff was speaking. So maybe Don, we got a couple more minutes here. Maybe you could weigh in on what you were agreeing with. Ooh, I think you're on mute. Oh.
Sorry about that. Yeah, no, I mean, Sarah, I learned so much. Like I said, I'm taking copious notes here. I'm going to want to connect with you offline to learn some more. But you know, what you're saying about GIPS, right? I mean, and I think there's a lot of soft power here that doesn't have to be as hard as you know, regulatory power. So, for example, the brand that GIPS has, you know, if we had some sort of tighter reporting framework in place that consumers and asset allocators like myself could have confidence in, that's something obviously we'd be asking for, right? And so it becomes sort of a de facto regulation that's put in place. And so I think that's ultimately needed with respect to this. You know, to take it probably a step further would be to understand. I'd like to understand more around the policy embrace of U.S. managers of these European policies. You know, you referenced Fidelity and BlackRock, and the reality is these are the largest allocators of capital in the world. They are going to certainly pressure politicians. You know, my view is the politicians will follow the money, and if the money is ultimately going in a direction that's pushing for more advanced ESG regulations, I think ultimately we'll get there. So that's what I was agreeing to.
Wonderful. And I think we got one more minute here. Maybe Sarah Rumpf, your last comment here as we tie everything together.
Sure. Yeah, no, I think a lot of what Sarah said resonated. I think the greenwashing comment and just focus on that in particular, I think makes a ton of sense. You know, just thinking about some of the stats that I've heard about how many dollars flowed into passive ESG strategies in 2020. It was I can't remember the stats, but it was some insane percentage of passive flows were into ESG strategies, and that's steadily increased over the last 5 years, which I think is great to some extent, right? Like people have the interest, people want it reflected in their portfolios. But I think, and this kind of goes back to the question and my comments before, but when you really dial into what those funds are doing, how they're actually incorporating ESG into their investment process and their security analysis, I think it varies greatly. And so I think whether that's done in a regulatory framework to put some guidelines or guardrails around that, or if it just becomes more, more industry norm, and there's some sort of industry standard in terms of how people think about that. I think it's very important because it's one thing for us as an institution to do detailed diligence on a manager, but for a retail investor who doesn't necessarily have that ability or time to do that or knowledge base, it's very different, and you want them to be able to invest in something that is real and doing what it's saying it does.
Absolutely. I know we had a couple other questions pop in as we wrapped up here, so hopefully we'll all join and talk them through in the networking meeting next. Sarah, I'll turn it back over to you.
Perfect. Thank you so much, Michelle, and the rest of the panelists. That was fantastic. And I appreciate all of your comments and like a couple of you mentioned, taking notes and learning so much from all of the fantastic panelists. We are now going to switch over to the networking break again. It's the same link or same meeting ID as the one we used this morning. The panel from before, making an impact, this one in global markets, as well as some of the panelists from building an ESG strategy or practice will join us there. I invite you to do so as well and turn on your cameras. We had a really great conversation last time. So I welcome you to do that again. We will meet back here at 2:30 p.m. Eastern for responsible investing across all asset classes. But otherwise, we'll see you in the networking meeting. Hello, everyone. Welcome back. We are just a couple minutes out from starting our next panel, Responsible Investing Across All Asset Classes. I'm going to call our panelists up to the stage now, and we'll get started in a few minutes. Hi, Dave. How are you today? Hi, Jordan.
Hi, Sarah.
Hi, Brad. How are you?
Good. How are you?
I'm good. Hi, Maya. Hi, Christine. Can you hear everyone?
Hi there. Can you hear me?
Yes, I can. Loud and clear.
Okay.
Everyone looks great. Sounds great. How is everyone?
Marvelous.
Oh, wonderful. Glad to hear it.
And will we just be seeing these pictures for the discussion?
Just for the introduction, and then I'll take them off. It'll be your faces.
Okay. And how long are we expecting this to last?
50 minutes.
Okay.
We run, and I'll send you a chat, but run until 3:15. Oh, sorry, that's 45. 45 minutes.
And how many people are tracking to be here?
How many people are tracking?
Like, yeah, like generally how many people might be listening in?
Well, we average about 150 for the whole day.
Okay.
So depending on how things flow, we'll see.
Great.
And so kicking it off, would you like me to do that? You had indicated, Sarah, that and we'd start off with sort of valuations and flows.
Yep. I'll intro you and have everyone introduce themselves. And then, yeah, Christine, you can kick it off.
And does that sound good, gang? Start off with, see how it goes, but start off with flows and valuations?
You think valuations, is that the key metric here?
Well, I was thinking when we had our call, we talked about, you know, are investors giving up return?
Okay, so return profile, yeah.
All right, well, we'll do some quick introductions, but I think the conversation's already started, so this
Good.
is fantastic. But Responsible Investing Across All Asset Classes is the panel. We have some wonderful panelists today to discuss how investors can use total portfolio strategies and solutions that embed ESG factors across strategies and asset classes, gain an understanding of how and why processes can be customized for each asset class. We have Christine Todd, Senior Managing Director, Head of Fixed Income US, Amundi Asset Management, David Mabey, Partner and Co-Founder of Chicago Capital, Brad Rollins, Director, Portfolio Implementation, Mariner Wealth Advisors, Jordan Ferris, Managing Director, Product Management and Development, Global Equities and ETFs from Nuveen, and Maya Joelson, Senior Investment Strategist from Paragon Wealth Management. So Christine, like I mentioned, I'll kick it off to you and I'll let you guys have a wonderful conversation.
Marvelous. Thank you, Sarah. Hi, gang. I know that when we talked a few weeks back, we were wanting to make sure that the investment community felt as we do that this is a large and growing area of opportunity and investment. And we wanted to debunk some of the concepts that you have to give up return for doing something proactive in terms of responsible investing. I wondered what you guys are seeing in terms of valuations, returns, and asset flows in your different sectors.
Christine, I'd be happy to start from the from an asset manager perspective, and I think something that has come up over the last 4 or 5 years since we've been in market with some of our ESG ETFs, is a lot of the conversations that we're having with our clients are starting to shift in a very positive way. When we first started talking to some clients about what ESG integration meant, there were a lot of assumptions that ESG sort of meant what SRI or socially responsible investing meant 20 or 30 years ago, being that we would simply pick out some sectors of the market that didn't really make us feel good, and we would exclude that from the investment portfolio. And that was sort of what you were left with. We would consider these negative screens. Now we're starting to have conversations about what environmental, social, and governance integration actually means. And that's using methodologies and data to integrate that into the security selection process. So you are being proactively good, but you're also taking in data that's going to help you make good financial decisions. So I like to think of this as being the best of both worlds. You can do well and you can do good at the same time. So within ESG branded products that are coming to market today, a lot of the products will compare companies within the same sector and will say, this is the company that is outperforming its peers across certain environmental, social, and governance metrics. And that company may be overweighted in the portfolio. And in terms of valuations, the products that we've had in market have actually exceeded the returns of non-ESG benchmarks in general. So I think we're getting to the point where product construction and the amount of data that we have available to us is allowing us to deliver some really strong results to clients that accommodate both their values, their personal values, as well as the investment needs that they have.
That's great. And Maya, Brad, David, are you seeing excess returns as well in socially responsible investing? And if so, do you attribute that to the fundamentals or the technicals of more asset flows going into products which are reflecting these values?
Yeah, I mean, I see it like, as Jordan was saying, my problem is there's a lot of money going into ESG, some accounts up to 1 trillion, and it's really catapulted after the Black Lives Matter movement. A lot more people interested in social and governance. The problem is, in my view, that the ESG benchmark is primarily determined by Morgan Stanley, I mean MSCI, which is spun out of Morgan Stanley. And so it's not necessarily reflective of what is ESG. So as Jordan was saying, they're doing well, but that might be because, okay, they take out energy is underperformed, and it overweights technology. So the top companies in those ESG funds are most likely Amazon, Microsoft, Apple, and those companies, are not known for being very diverse. Amazon's top executive team has 22 people on it. There are no Black people. 10% are women. So the problem is that most of the ESG funds are being dictated by a private company that's profit oriented. And so it's not necessarily going where the money should be going if people actually care about socially responsible investment. That being said, because they're overweight technology firms, they do tend to outperform indexes that include both oil as well as prisons and as well as firearms, which don't necessarily do as well.
Yeah, and just to add a little bit more, from the returns perspective. So I work at Mariner Wealth Advisors. We have kind of several different lines of business, and one of them is retirement plan business where we consult on larger plans. And there was a DOL rule that was kind of floated out late last year where, in some cases it was kind of framed as a shot at ESG investments because they had to stand on the merit of their investments themselves. They couldn't be chosen specifically because they were ESG. And the whole kind of framing seemed off to us because we've always looked at these funds on the same kind of footing as kind of traditional investments when we put them in those retirement plans. And so it was kind of a non-issue. And Maya, to your point on maybe the sectors being different, in an MSCI index versus a broader index or something like that. Tech has had a run here, of course, but if you look over a longer cycle, we still see that they compete head to head with the traditional indexes where you could probably say that some of those sector differences have kind of been muted over time. So I don't know that I have a reason, technical or fundamental, why that's happening, but it seems to be happening.
Yeah, and just going back on that, so I mean, diversity, there's been tons of studies by Credit Suisse and others, and as I said, I wrote the first paper for the World Economic Forum on at least gender and diversity and how that improves financial outcomes, but that's not necessarily what's attributing right now the outperformance. I would say that, I mean, I've done very well this year, last year, 40%, and that was partially attributed to companies like Tesla, which was up 700%, companies like NEO up 1,000%. So we definitely do see actually outperformance in the new energy phase, which has helped the people that actually want to invest in ESG.
Terrific. David, where are you saying? Oh, so go ahead, Jordan.
I was going to add one more point to that, because I agree with what Maya is saying, and that there's another layer of education that needs to be had at probably the investor level. And a lot of the products that are in market today, you know, some of the ones that we've built, they're sector neutral relative to parent indexes on purpose, so that we don't have a lot of performance that's being driven by sector overweights and underweights. Now, there definitely are products out there that do have heavy tech overweights and they're underweight energy and industrials, but there are a lot of products that are very close, and you see that outperformance being driven by security selection as opposed to the allocation effect, which would be driven by the underweights and the overweights to certain sectors. But going back to Maya's point on, you know, we need to really understand these companies. I think we're going along a progression with the investor base where assets have exploded. But if I still asked, even if on this panel, I ask everybody to define ESG for me, it's going to be slightly different. And you know, we're getting closer to what a total definition of ESG means. I think the industry is pretty close. Clients are still, you know, they need to get up the curve a little bit, and part of that is on us to do better education to understand how ESG is integrated into certain products, how companies are scored by the various ESG data vendors, whether it's MSCI or Sustainalytics or another data vendor out there, so they can have a sense for what's, you know, really in that product. You know, if there are, you know, prison companies, you know, as Maya mentioned, that score better than others, why are those differences in place? And if the sector as a whole doesn't do as well, why would they be included or not? So I think there is still an educational component that does need to be brought to the masses a little bit better, but we're getting there.
I think you make a good point, Jordan, about ESG and integration. And it really is a process of fundamental analysis and understanding how each company is acting in a sustainable fashion for both risk avoidance and alpha capture. So you might have a company like a utility that has, you know, a miserable carbon footprint, but their whole business model is geared towards correcting that and having a negative footprint in the future. And investors might be slow to pick up on that and catch the wave of that being a risk mitigation in their future. And so I think that in the US, the RFPs that we're seeing from the institutional market are all really expecting that asset managers are integrating ESG into the fundamental process. And while not necessarily explicit in stating that the mandates need to consider that for being included in the RFP process, it is discussed in the process of the interviews, and the asset managers are excluded from that RFP process if ESG is not, you know, a priority in the fundamental analysis. I don't know, David, if you're seeing that too.
Oh, we're definitely seeing that. There's a lot more interest, and the flows demonstrate that. And I think also the press and you know, things like this panel, our clients are very interested in it. And I don't know, we haven't had much success in sifting out the noise to do attribution that these investments have worked out well or not well due to the management's approach. But we absolutely think it's a very good attribute, and our clients are interested in it. And we think it's important to get our clients what they'd like to see in their portfolio. Defining it is another question, very difficult to get one standard definition. And I don't know if we really need one. But it's important that investors, both institutions, big endowments, pensions, and individuals are comfortable with their investments.
I would say on top of that, I mean, what I think one of the biggest problems is that there's not data and transparent, and we need common data. So the problem right now is a lot of, let's say, banks and others can cherry pick their data and say, oh, we're 50% women or 50% Black, but that doesn't mean that's the top echelons. So in the UK, where I used to live, they mandated that all the banks and other companies had to actually say at each level, how many women are there, so that at least you can track next year, did it go up or did it go down, right? It's improving or it's not. And I think they should do that for race as well. Right now in the US, you do see a few banks, for instance, like Citigroup, they finally report their numbers, and they're the only ones, which is great, but they also will have a huge gap of 20 or 30%. And so that's why you see kind of these weird anomalies where you have like oil companies at the top of ESG lists in, say, Europe, because those companies are actually reporting their data. And so they're getting a check mark for being transparent, even if the data is not good.
It's interesting you bring up transparency, Maya, because we're struggling to get our arms around the nuances of the new regulation coming out of the EU. The SFDR is forcing companies and asset managers to become transparent about how they view and measure ESG and the quality of their investments as it pertains to ESG. We've interpreted the level of transparency being enough to show a portfolio versus a benchmark in its ESG scoring and explaining the framework by which we approach that. I don't know if any of the fellow panelists have any commentary about the more aggressive regulation overseas and how we might see that changing things here in the US.
I can make a brief comment on it, and I think this is a good topic, Christine. And I think I would come at it from two different directions. One, what you see in the EU is the regulatory approach, which can seem somewhat blunt, but it does push that message. But from the other side, I would say this is the capital approach. So you see more money flowing to strategies that have ESG, whether as a mandate or it's something that's being included in their consideration. Back to your RFP question, we're not seeing many RFPs anymore that don't include some sort of RI, responsible investing type of question. So to the extent that continues to be at the front of investors' minds, companies are going to be forced to be a little bit more transparent anyways, regardless of what the regulatory regime looks like. Both of those are helping it along, I think. But there are pressures from both sides. If we look at the US, I think this is really interesting, looking over the last 4 years in the administration over the last 4 years, and then going into the current administration. Over the last 4 years, we could argue that the administration was not very pro ESG. So as a society, we went from sort of having a supportive public side that was going to be supportive of ESG and sort of pushing this forward for us, to really having to do it from the private side. And there were some big strides that were made over the last 4 years in terms of ESG that sort of offset some of the policy approach that was going on. Now we're back into this regime that presumably will be more supportive of an ESG type framework. So I'll be interested to see how, with both of those forces moving in the same direction, how quickly we may catch up to the EU, or what actually happens over the next 4 years to improve transparency around reporting.
Yeah, to be a little bit of a devil's advocate, I guess my concern is that if you don't mandate consistent data, the companies just cherry pick their numbers, and it's lipstick on a pig. If we go back to assets, only 1% of assets under management are managed by women or minorities. So, it's those same funds. We just have this whole issue around GameStop and Robinhood traders, but they're saying who's hurting the hedge funds? Those hedge funds are not diverse, ESG type people, but yet they're getting tons of flows by the big pension funds. Teachers associations are going, unfortunately, at the end of the day, to non-ESG type investors.
Good point. And I didn't know if Brad or David, you had any thoughts on transparency and consistency of data and disclosure?
Yeah, I'd say that taking this back to kind of how one of our use cases and how we try to make ESG investments across the capital structure available to our clients is in a big sense through different direct indexing type of applications. And so getting broad exposure with a tilt towards ESG and maybe even some negative screening. I think there still is a place for that in customizing for a client. And so, I mean, this seems like an obvious statement, but in that vein, yes, the more data, the more consistent, pristine the data to really be able to drill down and make important decisions, allocation decisions on that data would be huge. I am not well enough versed in the EU rules to really weigh in on that piece of it, though.
It certainly seems like the CEOs of the major companies in the US, which are of course multinational, are becoming more and more activist. Jordan made the point that it's, private hands are driving, if you will, improvement in this area. It will lead the capital. Well, do we think the capital and the leadership will lead, especially with the support presumably of the Biden administration, to more awareness and continued capital flows in the US like we've seen in Europe? I know, David, you manage custom portfolios for those who are looking to do well and do good. Do you have any perspective on that?
I think the whole thing starts with customers. So I think CEOs are responding to their customers, and I think customers are demanding good corporate behavior. And while everyone may have a difference of opinion about exactly what good corporate behavior is and what defines those characteristics, I think the message is loud and clear, and I think it's here to stay. Our customers want the same thing, and we're very responsive to them. So I think CEOs and public company boards are going to be a lot more interested in this, and I think it's already shown. I think the Biden administration is following, not leading, but I think they're important in the conversation, and I think disclosure is going to be important. And in the front end, like we are now, I think there's a lot of difference of opinion about the statistics that are disclosed, and Maya got into several examples of that. But my hunch is over time, the marketplace will be the judge.
I do think the Biden administration is certainly helping new energy type stocks. So they're driving that. And then this minimum wage is interesting. I have different views on whether I think it's good or bad, but I think as far as the intention is to try to help not just the top 1% as far as building their portfolios.
I did notice that of the 30 odd executive orders we've seen from the Biden administration so far, you mentioned, Maya, the $15 minimum wage, also some reference to food insecurity, of course, rejoining the Paris Accord and canceling the Keystone Pipeline, or focusing on the environment, but also some proactive measures regarding equality in the workforce, and some ethical standards where appointees in the administration are going to have to sign up to not deal in their own self-interest, for example. Does anyone have any commentaries about that and how that might drive investment and drive any change in our space?
Well,
yeah, go ahead.
Go ahead, Christina.
No, Jordan, you
go.
go.
All right, go ahead. So I think this will help to drive some change. And I go back to something Maya said that which I agree with. It is, as of right now, there is the ability to sort of cherry pick your data. And I think that's why it's important that we have both public support and the private support, because both of those driving together are going to get to the sort of a better goal or a better state eventually. With the executive orders, there are a couple of things there. I'm excited to see that those, we could link those to sort of the E pillar within environmental, social, and governance, and the S pillar for the minimum wage. I think for a lot of people in understanding what ESG actually means, I think people can grab a hold of the E pillar a little bit more easily. They understand climate change, they can see that around them, or they can at least see it on the news, and that ends up being a little bit more tangible. The social pillar is a little bit more difficult, I think, to grasp. It certainly is, it was for me to grasp. And I think something that the pandemic has provided us a little bit more insight into is that social pillar. What companies were able to make the transition to work from home a little bit better? Which companies are in a business or in an industry that can actually have a remote work environment? You know, the services industry, you know, somewhat decimated because of the pandemic. And that's where those things like food, basic nutrition, and minimum wages really come into play. So you're putting into place executive orders that are going to help support that S pillar a little bit more. From an investment perspective, you're looking at, you know, what industries are these going to support, and that can help you make investment decisions. And to the extent that you can view companies that are better positioned against those peers within those categories, this is another way for you to, you know, to deliver returns to your clients potentially.
Thank you. You alluded to something that I wanted to get the feedback from the rest of the group, which is the UN SDGs, United Nations Sustainable Development Goals. And how important are the UN SDGs to your investment process and your evaluation of those 3 pillars?
Well, I would just say, so you know, so I spent a lot of time like in Europe, spending time there, and you know, this week we're generally in Davos, and there's so much talk about the UN SDGs. In the US, there's much less talk about what they are. It's really, as I said, MSCI is really dictating what they call ESG. And so, you know, and that's why I call into question why a private company should be doing that. I mean, at this rate, why don't we just get Lehman Brothers to decide what our ESG companies and what aren't? So I think in the US, unfortunately, I don't hear much. There definitely is interest from clients as far as investing in sustainable companies. And so my approach is to actually individually pick stocks based on their values. Because everybody, they weigh things differently as far as, let's say, Nestle is actually on the top of some companies as far as their ESG, and other people say, well, what about, you know, the African cocoa farmers? They're not being treated very well. So there's a lot of, I think, as David said, there's a lot of individual trade-offs. Like, so one client doesn't want to invest in alcohol, but he'll invest in Nestle. Another client doesn't want to invest in Nestle, but what is happy to invest in alcohol, things like that. So there's a lot of, there's so many factors with companies and people's moralities. And so that's why, you know, I do a customized approach, because it's so hard to do one size fits all that actually works.
Good point. I know that Brad and David specialize in building custom portfolios. And I wonder what that process is, how important the UN SDGs are, and you know, what sort of factors you integrate. Also, if you could share a little bit about the challenges of that sort of mass customization. As an institutional type investor, we see that as difficult to manage smaller portfolios in a customized fashion.
Sure. Yeah, I'll start. And so Mariner is a financial planning firm. We have 350 associates across the country serving their clients. And Maya, you mentioned it at the end, but you know, everybody has their own definition. Unfortunately, or however you want to look at it, maybe it is fortunate that these are the values that they think are important. These are how they want their dollars to kind of go towards that. So we've taken a pretty broad approach to how we do this. And we have an in-house equity team that does manage ESG portfolios that are not customized. This is you know, fundamentally driven stock picking portfolios. And I think the UN guidelines are a factor, but only just a factor among many that go into their research process in picking the best of breed stocks to fill out that portfolio. that's just a handful of portfolios. So there's still several different iterations of ESG that a client may come to us with. And I think that's where the mass customization comes in. We really do that through a quantitative program that is, maybe it has a basis of kind of an inclusive pool of stocks that have, starting with generally high ESG companies as defined by Sustainalytics or some other provider as kind of the starting point, as well as kind of an asset class target, large cap, small cap, mid cap, whatever it is, because this is being driven not only for ESG purposes, but also this is, you know, being driven by an advisor who has a view on what's in the best interest of this client long term, what asset classes do they need exposure to, and what quantities. You know, there's so much that goes into this equation. So that mass customization on our part is starting with that kind of pool of high ESG companies and then further tweaking based on usually not the advisor's view, it's going to be the client's view on what is important and what do they want their dollars to go to. And then running that through a quantitative program to push out a portfolio that's custom to that client based on their goals. Relying heavily on technology so that we can do this at a lower dollar amount. And for lots of people in lots of diverse situations, but really pairing those two together with the fundamental deep research on one side in some asset classes, and then pairing it with the more quantitative approach in the others has worked well for us and helped our clients to get the exposure that they need and in the values that they want also.
Excellent. David, how do you marry deep research and customization? How is that efficient for you?
Well, it's probably not, but we do it. We try to involve the clients in the discussion and try to get their views on what's important to them. And as this panel has gone around the horn here, different items, it's very clear, are hot buttons for different, individuals. And I think our clients are the same way. And so we do try to have a pretty good discussion with our clients. And it's not just a one-timer. This is a repeated, ongoing discussion because everything changes. Companies change, things evolve, the environment evolves. And so it's important to us to keep that going. We do have some tools that Brad mentioned, including the portfolio accounting system and others. One of the attendees asked, how do we choose managers? I think the way we do it, it's not necessarily the right way, but it's the way that we've chosen, is we'll look right through and look into their portfolio and see what we think of those companies. We don't necessarily care. Don't get me wrong, the UN guidelines and all these other things are very important, and as Brad said, part of the process. But I think we like to see what folks have owned, and sometimes it's hard to see what, for example, in a public mutual fund, hard to see what they owned in between the reporting periods. And people can trade in and out of stuff that they think is going to be high performance items that aren't necessarily meeting the definitions that we all hope and expect they will. So it's a challenge to do manager selection, but we think the best way is to look straight through their portfolio. And that also means that it's a challenge in two other areas. One, index funds are difficult. Oftentimes the index funds will have things across, a wide spectrum. And as Maya said, it's MSCI or the S&P 500 that people are trying to sit on top of. And the other thing is, and Christine, maybe you know more about this than I do, other asset classes, non-equities can be a challenge. And I think one of the attendees asked about that, particularly some areas of the debt market, I think can be kind of challenging to dig in and see exactly what's behind there.
I couldn't agree more, David. It is very challenging in fixed income. After all, we don't have the power of a proxy vote. So our influence on one-on-one with companies is diluted. Number two, we have a limited time horizon. So a lot of the benefits of the negative cash flow investment in the long-term sustainability of a company won't accrue to fixed income investors. And we have to be careful about managing that time horizon. And then, as we've talked about the panelists, lack of a benchmark is, makes it a real challenge to evaluate. We have multi-sector portfolios where, all 6 of the data providers don't provide enough to cover, 50% of the portfolio in terms of rating it. Particularly, you alluded to one of the questions from the audience, the areas of securitized and muni bonds lack standardization and data. So, one way we're solving for that, for example, in muni bonds, is looking at the revenue bonds rather than the general obligation bonds, and really understanding what the sources and uses of funds are. And in doing so, you can see that the $4 trillion muni market is solving for the problems of society like retirement, education, poverty, environment, and we could go on with some of these very discrete, highly impactful projects. Secondly, in securitized, you're talking about packages of loans where there's no business. There's no employee, no management team, no business activity. These are the things that Maya's been alluding to, but we don't have that here. Securitizations are often done by private companies, so you don't have that as a reference. And there's no, as we discussed, third-party rating. So really what we're doing in securitized is we're looking for best practices, that products are affordable and not exploitive to the consumer. Reasonable amounts of documentation is one way of ensuring that. Remediation opportunities, like in reperforming loans being packaged. So those who have suffered but have corrected their woes should be deserving of higher credentialed ESG. And then there are securities out there which actually promote neighborhood stabilization, like single family rentals, allowing families who can't afford to buy to live in a single family detached home in a neighborhood, for example. I don't know, Jordan, if you have any unique experiences in the equity markets and some challenges there that you're able to overcome in terms of measurement and engagement.
I do, Christine, and I have the opportunity to actually cover all of our ETFs, so both the fixed income and the equities, and I would comment on some of the differences there. Within the equity space, some of the challenges are, and those, go back to a couple of the points that Maya made, is you get essentially one score at the company level, and if you're scoring a conglomerate or a multinational corporation, there are probably some very good parts of that business, and there are probably some parts that people may object to and may not want to own. But when you're buying an equity, you're buying the whole thing. So it is, in one sense, a little bit more simplistic, which I think it provides us an advantage when saying this is how we would score a company, and this is why it's included. It's sort of XYZ. It's very easy to get to that answer. Where I think where you have a huge opportunity on the fixed income side is in use of proceeds. I think muni bonds are a great example of that, but we're talking about a corporate bond that's going to fund the development of like a wind farm or something like that, as an example. So you could have a bond coming from a firm that otherwise would not be included in an equity strategy if it's a publicly traded company, wouldn't be included because they have a huge carbon footprint. Their diversification policies are not existent. Let's say, corporate governance score is very low, just as an example. However, they're issuing this debt that's going to go fund the construction of a wind farm that is going to, and this goes back to that tangibility, that is going to power 100,000 homes, just as an example. That's something that people can grab a hold of, and that has like meaningful impact that I think resonates with investors very directly. So I think there are some great opportunities on the fixed income because you can incorporate this use of proceeds concept, and you can get fairly narrow in terms of what you're investing in. Whereas on the equity side, maybe a little bit more simplistic, where you have a broader swath of the company that you're going to be owning.
I'd say also too, alternatives. Yeah, with bond yields so low, that's, I think we had a conversation, Christina and I had this Maryland client, and we had to try to find another state, and we looked at Nevada, and it's like, is that a blue state? Is it a red state? Are they going to invest in prisons? So it's nice you mentioned that revenue, looking at revenue bonds, so you understand actually what the money is coming from. I would say also, because I've been looking for alternative yield instruments, I found, say, renewable energy, wind and solar farms that set up near utilities with over 6% annual yield, as well as affordable housing, workforce housing, which are all doing well, you know, in this environment. And so I actually prefer that. I used to have, you know, the Blackstones of the world that were investing in Vegas and the Cosmopolitan, and now I'm investing my clients' money in workforce housing and things like that, which are actually helping, you know, and providing a good return.
Excellent. We're sort of nearing the end of our discussion, and I thought it was important for us to cover how we view the differences in ESG integration, responsible investing versus what could arguably be called outcome-oriented investing, impact investing. How do you all see the differences there, and how do you manage your investment strategies accordingly?
I can kick it off. So we see kind of responsible investing as the sort of the all-inclusive label, and then underneath that there will be a few different flavors. ESG integration would be using ESG data to influence your security selection process. So another tool, called maybe another factor that you can utilize, that portfolio managers can utilize to make the correct decisions on behalf of their client. I would compare that against impact investing, which is much more, what are the use of proceeds? Is there a direct and measurable impact that you can see coming off of that direct investment, which is why I was giving the example that's more akin to fixed income investing, where you can see that direct impact being had. So those are the two differences between the acronyms and the word that I hear, impact, that come up most regularly. The other one is SRI, or socially responsible investing, which is more closely aligned with negative screening. So simply identifying those industries that don't really make us feel good. The hot dot ones were tobacco, controversial weapons, civilian firearms manufacturing, things like that, and just excluding them from the portfolio, regardless of what their ESG scores or any impact they may be having.
I would say I agree with a lot of that. ESG investing, I see, is that's what I do for my clients, because it's more about what kind of, I want to get them a solid return, but also invest in companies that they believe in. Whereas impact, I think it's more related to philanthropy, Bill and Melinda Gates Foundation. If your donor money, how is that going to have, the metrics are different. It's not return necessarily. It might be, how are we going to, save as many lives as we can in, a poor underdeveloped country. And so for me, I think of impact more around philanthropy and making sure that money gets the best benefit as far as social good, not necessarily return for, which is what my clients are, it's the retirement savings. So they care about that money comes back to them at, higher rates.
And Brad, David, are you able to deliver custom impact solutions, or are you more focused on as Jordan mentioned, sort of the umbrella of responsible investing?
Yeah, I'd say, using Jordan's definition, which I largely agree with, our focus has been on the ESG and SRI components and less on impact, at least at my level, in that kind of centralized investment management group role. There may be some of that happening in a client-directed type situation with their advisor, but it's not something we're managing centrally.
I'm just glad that Jordan explained what all those three-letter acronyms mean, because I get lost in all that. It changes. Everybody has a different view. Again, I think the important thing is we get, there's clearly demand. One that hasn't been mentioned a lot is privacy. That's a big issue with a lot of our clients, and it's more recent. Younger people might be less interested in privacy, or maybe just more comfortable with the lack thereof. But I think it's okay to have all of these things evolve over time. And I think the key, one of the things you touched on, Christine, is if you can get very granular and some of the fixed income products, because they're contractual, you can fund a certain project, and it could be a company that's creating lots of problems in other areas, but they're trying to make progress on fixing them. I think all of those things are very important. And the hard part is to get them to scale, get those things delivered without a lot of labor intensity for the investment managers.
Excellent. Yes. At Amundi, we developed our ESG framework from a team in Europe. So I think that was more mature, I guess, than what we're seeing here in the US. We started with using the data from the 5 different service providers and weighting the importance of the data according to the expertise of the service provider and the importance to each sector of the economy. And then out comes a score. And then we assign a momentum score on top of that one, final, A through G rating. And the momentum score gives us a sense for where the portfolio is going with the investments there in terms of, is it improving or not improving? Is it beating the benchmark? And the final stage, we've solved for really with thematic strategies, where we can identify biodiversity, circular economy, negative carbon footprint, whatever clients might prefer, and really measure the outcomes according to those themes of each company that we're investing in and the specific bond issue that represents. So it becomes very rigorous and very time intensive. So not really yet a mass produced type of solution for clients in terms of impact and outcome measurement. But it does seem to be the wave of the future in terms of what investors are seeking, that their capital makes a difference in an area that's important to them. I don't know if anyone has any thoughts on that.
I have a question about that, Christine. I'm wondering, because that's a pretty elaborate process and I think a very useful one that you're describing. If you put GameStop for your screens, I wonder where it would show up.
That's a good question. I haven't looked at the ratings there. But
not very high. I would think not very high.
Yeah, but given the current situation, I hope it's not very high. But our job is as investors to catch those kinds of Achilles heel early, and by focusing on and prioritizing the ESG factors in the investment and analytical process. We, as this panel of investors, believe that we can prevent our clients from finding themselves in an at-risk position with the investments in their portfolios. I don't know if anyone has final comments on that.
Yeah, and I would just say not only investing in the right things, but getting a higher return, because you have less risk as far as reputation risk, but 2, yeah, I mean, there are growing industries and new energy and things like that, so you can actually get a higher return and invest according to your values.
Great, we're wrapping up. Jordan, David, Brad, any final comments?
I would say as the industry continues to evolve, I think it's helpful for these types of panels to come together to share the education that, share the work that we've done, hopefully increase people's education of ESG, of responsible investing impact, so that when they are looking to evaluate their own portfolios, if they're looking to integrate certain values, they can be starting from a better position in terms of knowing what they're owning and understanding how ESG integration can drive returns in the portfolios. But it's been a pleasure being here. Thank you, Christine, for taking so much of the lead and navigating us through.
Great.
All right. Well, thank you all so very much. Thank you, Christine, for facilitating that, and to the other panelists for their fantastic contributions. I know you'll join us for the happy hour after this next panel, so I'm looking forward to seeing you, but also to that as well, and finishing out the conversation and the day. So thank you all very much, and I will see you for the happy hour. And we're going to move over to the next panel. I'll call those panelists up.
Thank you.
Thank you.
How do I leave? Do I leave here?
Gotcha. Hi, Cara. How are you?
Hi, Sarah.
Hi, Holly. How are you?
Hi, Sarah. Hi, Cara. I'm well, thank you.
Hello, everyone.
Scott.
Hi, Scott.
And we're just waiting on Jules, but we'll go ahead and get started, just so that we don't run too far behind. But we will do a couple of introductions, and then I'll let you guys get into the discussion. So I'm so happy to finalize our last panel of the day, Impact Investing in the Context of Today. Panelists discuss how they are addressing clients' goals to make a difference without sacrificing on returns, and how they work those themes into every aspect of your client's account to maximize their impact. We have our wonderful moderator, Hallie Modasser, partner at Stearns Financial Group, and also a wonderful author. I'll let her tell you about her book, but she has a fantastic book that she's written. Cara Barr, Managing Director of Brighton Jones, Scott Loke, Principal of Cap Trust, and Jules Pulda, Investment Analyst at Ballantine Partners, who is here and I will promote. So thank you all very much for being here, and I'll let you introduce yourselves just a little bit more.
Thank you, Sarah. And I'm so honored to be here on this panel, and especially with my esteemed colleagues. I want to just take a few minutes to tell you about myself, and then I'm going to pass it around to everyone and let everyone give a little bio about themselves and what their practice areas are. So my name is Hallie Modasser. I am a partner and senior advisor at Stearns Financial Group. It's a registered investment advisor. As Sarah mentioned, I've written a couple of books, and my most recent one came out in February of 2020, right before the pandemic, and it has to do with boomer women and ESG investing. It's called Women on Top, Women, Wealth, and Social Change. And so I did a ton of research on this for the book, and then the pandemic hit. And I thought the book would become completely obsolete with the pandemic. And as it turned out, it actually made it more relevant. So I'm excited to participate here today. And let me pass it off to Cara. Can you talk about yourself for a minute?
For a minute. Cara Barr. I am excited as well. It's always a topic when business and wellness and impact come together. So I've worked in industry for 20 years, from the BlackRocks, the larger institutions, running and building billion-dollar funds for our largest institutional investors, all the way down to being the CIO of a smaller impact investing startup where we launched and rolled out very thematic funds around clean water, animal welfare. So I'm now sitting happily in the middle at a mid-tier Brighton Jones. We are an RIA as well. We're highly focused right now on what we're calling financial well-being, and we'll get into that, but it's essentially aligning people's time and money, so their resources, with their passions and purpose. So really bringing together all the traditional types of focus and planning areas we would work with clients, as well as aligning with passions and delivering impact in that regard. So excited to talk about that some more.
Great, thanks for joining us. Scott, tell us about you.
Well, I have been in the institutional investment consulting business. I added it up and it kind of freaks me out, but 39 years.
Wow.
It's, yeah, it's something that's sort of snuck up on me. But most of that time period has all been centered on institutions. And So I come at an institutional consulting perspective. And today I'm primarily focused probably 95% of the time on our endowment and foundation practice at CapTrust. CapTrust is a national investment firm, investment consulting firm that really has expertise in a variety of areas, including institution and ERISA management as far as that goes, and also a wealth practice as well.
Great, thank you, Scott. I look forward to your perspective on the institutional side. And Jules, tell us about you, please.
Hi, so happy to be here. I'm Jules. I work for Ballantine Partners. We are an independent wealth management firm based in New England. We work with roughly 200 families, about half of which are in the family office ultra high net worth size, the other half in the high net worth range. And what we do is we provide a full suite of comprehensive planning and investment services for our clients, each of which is individualized as they all have different needs. We have about $7.5 billion in AUM. And within our firm, we have an impact investing practice, which is where I sit. And about a quarter of our clients participate in some way in impact investing, whether it's a slice of their portfolio, and we have others who have goals of being 100% invested in a socially responsible way. Before joining the impact investing world, I was working in the nonprofit world where I worked with refugees and asylum seekers in the Middle East for 6 years.
Wow, that's impressive. I love that. As a person from Middle Eastern origin, I'm especially impressed. Well, so I don't know if you guys were on the last panel, but I was listening in, and even in that panel among a team of experts, I noticed that there was some not complete uniformity in what is the definition of impact investing. And so I guess for the purposes of this panel, I think it'll be really important for each of you to define how you view socially responsible investing. So one of the, they named out so many acronyms, but there's ESG investing, there's impact investing, there's SRI, socially responsible investing, there's values-based investing. And so these things, unfortunately, have taken different meanings within the industry. And I think it's important to clarify for our audience how each of you view that. I know we at Stearns have just launched a platform that provides our clients the ability to invest in alignment with their values. It is an ESG platform, so it is a portfolio-driven platform that basically adds another tool or factor to fundamental stock analysis. So the goal here is that you would have at least equal returns to a non-ESG portfolio while also aligning your portfolio with your values. So let's take a minute and talk about, Jules, if you would, tell us what impact investing means to you.
Sure. So thank you for framing that. What we actually do is we try to stay away from the nuanced differences in terminology when we are discussing impact investing with clients, because in my experience, they're not that interested in the weeds, in getting into the weeds of the different nuances. So we tend to use impact investing, that term, as an umbrella overarching term. And the key point there is that we view impact investing as investing, not philanthropy or not grant dollars. And we, when discussing impact investing, we try to stay away from the concessionary or giving up returns for good conversation, because while there are plenty of opportunities in a portfolio to make impact, whether it's granting or blended capital, concessionary loans, et cetera, or providing capital to a company or a fund with the expectation of outsized impact, but a high risk profile, and we encourage and support those investments, we segment that in a separate category of opportunities from the pool of capital, which is invested for market rate or market rate returns, or to perform as well as investments that don't have ESG baked into their strategy.
Okay, good. So you're looking for equal return and impact, presumably, in your portfolios, not one for the benefit of the other.
Sure, and within each asset class that looks different, because return profiles are different within each asset class. So that's that we are looking for returns or investing in a way that provides competitive returns with social and environmental returns within each asset class.
Yeah, understood. Cara, tell us what you guys are doing.
Yeah, I agree with Jules. So we'll start off on a nice tone of agreement. And I would point out that so the GINS definition, which is a pretty commonly accepted definition of impact investing, is investments made, and I'll actually read it so that I'm not making it up. Investments made with the intention to generate positive, measurable social and environmental impact alongside a financial return. So I think the difference, whatever overall term one chooses to use, the difference between ESG, which is considerations around governance and social factors and environmental pieces within a company's profile, is that there's an intention to generate financial returns, but you're also reporting, you're measuring and reporting on the impact. So I think a lot of just ESG funds, which are tilting, negative or positive, they might call themselves impact, but unless there's that piece of reporting back and delivering measurable outcomes, I think they fall short of truly being an impact fund.
Yeah, I do agree that the definition of impact investing has to do more with measuring the impact, whereas ESG is one hopes there's an impact. And if you're doing things like proxy voting and shareholder resolutions, you clearly are making an impact, but there is that distinction. Scott, what about you on the institutional side? Tell me what you guys are doing.
Actually, on the institutional side, there's really no difference than what Cara had just described. I think the concept of outcome oriented is really the way that we take impact, and whether it's an environmental impact or a social community impact, along with the impact that you get from appropriate returns. That's kind of the way we sort of put parentheses around impact investing. It's outcome oriented.
Yeah, agree completely. I love the idea of measuring, because you can do a lot of stuff, but if it's not having an impact, quote unquote, what good is it, right? So great. So I know that in 2020, we saw a huge boon in I'm calling it impact investing. I think the literature I was reading, which was out of Bloomberg, actually called it ESG investing, but that something like $20 billion of inflows into ESG investing in 2020 versus the $9 billion that was in 2019, and that was a record. And so there was a huge push of inflows into this space, even while much of the market was exiting. The market was down 30%, people were still pouring into ESG. So tell me what you guys think that's attributed to in 2020 in particular. Jules, you want to kick that off?
Sure. So I think that it's a combination of several things. One is that the field is growing. It's hard to find an asset manager or a private manager these days that doesn't have at least one ESG or impact strategy on their platform. So generally, there's more and sometimes better offerings to choose from. Another piece is that the returns, they speak for themselves. This industry is no longer in its infancy. There are funds with 10, 20, even 30-year track records that have incorporated some type of environmental social consideration into the core of their strategy. And while the values part of the conversation is still important, the value side, that companies that are making sustainable changes, that are thinking about the well-being of their employees, they are creating more value. Those are stronger investments with less risk from a financial standpoint, and that's playing out in the returns. And then finally, and this may be something unique to working with families, but people really want to make a difference, and they want to talk about it. This year, we saw a shift in conversations with many clients. They're just 2020 really rattled people. whether it's with conversations or concerns about the planet and climate change, or the health and economic toll of the pandemic, or social inequities that exist and have been exacerbated by the year. There's been an increase in conversations about wanting to do something, wanting to do more. And for us, that opens the door to be able to have a conversation about better aligning their portfolios and investments with these issues that they're caring about and that they are talking to us about.
Yeah, and I think in your case in particular, Jules, you're working with ultra high net worth people. And I've noticed in our practice, so I don't know if this is true across the board, but the higher net worth the client, the more, it's like Maslow's hierarchy. They're not worried about food and shelter. They're worried about making a difference and leaving a legacy and making a better world for the future. And I have found the pandemic, just the disparities in access to education, to healthcare, to jobs, what that did and looked like. And then the George Floyd incident really triggered something in this country where people who have the means, the economic means to make a difference, really suddenly want to. And thank God we have a mechanism through which they can do that. What about you, Cara? Did you see the same sort of thing?
Certainly, yeah. So environmental sustainability has always been on the top of the list in terms of interest. So that has certainly been talked about. Other areas that we get questions about, usually, ebbs and flows. If there's been a mass shooting, there's queries about guns and weapons manufacturers. Sometimes, occasionally, drug abuse and opioids. However, no question, between the coronavirus pandemic and the BLM movement, there's been it's just social factors have been brought to the forefront. How companies are treating their employees, their supply chain. Social issues are becoming much more real and harder to ignore. Historically, the governance factor had a higher premium, and it's been shown in the past year that the social premium, it doesn't lend to big bubbles. Like it's more subtly measured, subtly tracked, and I think more subtle in terms of change and impact. But a study last year showed that there's been a 2 basis points increase in the social premium. And so that is just a function of the times we're in. And I think it's a great time.
Yeah, and I think environment's always been there too. I mean, clearly we have an environmental issue on our hands, but I agree that this is the first year the S has been at a premium. I know in the research that I did for my book, I found that less than 30% of Americans believe that either philanthropy or government can solve our social problems. So it's kind of dismal, I know, but more than 70% of that same cohort believe that companies can, that public companies really have become power brokers of our society, for better or worse. So you may or may not agree with what, let's say, Twitter did or Amazon did, but clearly it demonstrated a tremendous amount of power. And so I think the public has recognized that and can use their dollars, their investment dollars, to help leverage that power.
And I think corporations have also realized that as they've sort of leaned in to the social justice issues of the past year, they are now finding a whole new voice that they really, I think in the past were reluctant to put out there. And that in turn is bringing others to the party, for this whole topic.
Yeah, it kind of is the self-fulfilling prophecy a little bit. And I attribute a lot of this to the rise of social media. And, we're a click away from any bit of news. It's not like back in the day where people could do things and you wouldn't find out about it because it was across the country or across the world. And so really reputation and a company's stance and position on issues is instantaneous to most people, which is why if you have good governance and a good steward of these things, it actually reduces risk. Like Jules alluded, reputational risk is at stake here, and that impacts shareholder value. So why don't we each talk about the actual platforms that we have at the places that we're each working? And Scott, start with what you guys are doing at CapTrust.
Yeah, so as an institutional consultant, you know, a lot of our clients are not-for-profits, and you know, the whole concept of, and I'm going to put the broad umbrella of ESG out there, but that whole concept has been on their minds in various ways. Our job is to really meet each of those clients where they are. Some are much more advanced. Some are already putting money into another piece of the alphabet soup, MRI, mission-related investments, which are slightly different from impact investments in terms of the nomenclature and the nuance. But I think that it's really important that our research and the folks that we're dealing with, we have an ability to speak to them where they are. I can tell you that 10 years ago, when this first started coming up, it was looked at askance by most of the fiduciaries sitting around the table. They just automatically in their minds thought that if you were going, of course, it was probably more SRI focused, exclusionary, but they thought if you exclude something, you're missing something, and therefore that's going to negatively affect returns. That hasn't been the case, but in the last 2 years, I would say that you know, the clients have come to us again, some never having done anything, others right in the midst of it, and our research team identifies viable strategies. You know, we use a combination of general analysis and that is both looking at enhancing the common good, but also helping a long-term fiduciary-driven portfolio grow. So we don't have a platform per se in that sense, because we don't have a product in essence, but what we do have is the research that backs up the kind of questions our clients are asking.
Yeah, I hear you. Jules, what about you guys at Valentine?
Sure. So our platform, or our program, is that we approach impact investing with our clients in 3 major steps. The first one is to know what you own. Know what your investments are supporting positively and negatively. Then the second step is to align values with your portfolio. The third is then to use that knowledge, to use that understanding to make a difference. And it's an iterative process. It's more of an art than a science. And because we work with families, that program, it's pretty individualized. Even within one family, there are often different opinions, different priorities and passions about you know, what they want to do with their investments. So we typically start the conversation around the values piece, trying to identify what issue areas are the focus for the client or for that family. Then we use that to match their values with the strategies and managers that we've approved within each asset class that the client holds investments. We have a few thematic pillars that are prevalent themes or values for our clients. One of those is environment. Another one is gender lens. And then we are building out a racial equity pillar as well. And then sometimes clients have passions or interests that aren't addressable through the public or private markets. So we do what we can in those markets. And then we also, those that aren't addressable there, we will try to find concessionary loans, CDFIs, or philanthropic or granting opportunities for very specific things. For example, I work with a client who is really passionate about preservation and restoration of older books and documents. Have yet to find any investment managers that are focusing on that. If anyone knows of one, please shoot me an email.
That's great. You guys are doing a lot of customization. As I mentioned, we just launched our platform at Stearns, and so this is new. We have had, been in business for 30 years and have, $1.5 billion of assets under management, but we have had traditional portfolios and various risk tolerances. So introducing the topic of ESG to a broad swath of clients and then educating them and having some of them opt to make the switch over has been a little challenging, just because if you have after-tax assets and you're coming off, well, we're in a 10-year bull market plus, there are a lot of gains there. So we're kind of starting in the retirement accounts, and it's iterative. And so we've got core strategies that are more plain vanilla. And for the higher net worth investors, we have more customizable approaches available. But I mean, it's definitely a challenge to make a switch. So we know generally that this trend is being driven by millennials and by women. And I know I've done tons of research on this, and 90% of millennials are interested in socially responsible investing. 80% of women are interested in socially responsible investing. But ironically, when I did the research for my book, I interviewed boomer women, 500 of them from across the country, and was shocked to learn that 80% of the boomer women didn't even know what ESG investing was. So they didn't understand that you could invest your assets in alignment with your values, or that you could you could leverage your voice in that way. Rather, they were focused on the traditional means of the ballot box and philanthropy. And so my personal mission is to try to help educate women who, as we all know, most people in the investment industry know, control a vast majority of the wealth right now, just because of the double inheritance, either widowhood or parents dying. They control as much as $20 trillion of wealth, which is in the same realm as our national debt. And so a huge amount of wealth that can be applied to social causes. And so I guess I'm curious in terms of you, Jules, in particular, because I know that you guys have a big platform and you're working with higher net worth people. Do you see an interest among women in your practice?
Yeah, the short answer is yes, absolutely. But I, to your point, I think that there is a really interesting misconception that millennials are driving impact investing. I would say that millennials are driving impact. They're driving companies to be better. I mean, we are laser focused on our consumption, who we're buying from, what the supply chain looks like, what materials are sourced, et cetera. But they aren't driving the investments piece because they're not the asset, they're not the ones who actually currently have the wealth. And what we are seeing is it's the boomers that are driving those conversations. And it's mixed. Some people are hearing about it on their own, reading about it, New York Times, Wall Street Journal. I feel like articles everywhere about ESG or impact investing. But a lot of it is also internal education and introducing it. And a lot of women, a lot of our female clients are jumping at the opportunity. Yeah. And it really gives them, a lot of people, a lot of women, the first time to be deeply involved in their investments, to have decision-making authority in the portfolios, as traditionally a lot of advisors typically turn towards the husband or the male members of the family when discussing finances and planning. But impact investing, it gives an opportunity for everybody to be involved, which ultimately just, we see, allows for more engagement, more ownership over the wealth, better decision-making, et cetera. And you actually mentioned this earlier, but something that we are hearing a lot from our female clients about, the reason why they're choosing to do this is because they're thinking about their legacies. What kind of impact do they want to have on the world and on their families? So it is common that it's coming from the female boomers, and they're inviting their children to the conversation. So involving their children, the next gens, to help them make decisions about how to invest, which actually sets them up for success when the family wealth will eventually be passed down and they can be wealth owners themselves. So there's this legacy piece that's really strong that we are seeing coming from our female clients.
Yeah, and I have found it as a boomer woman myself. I've just been thrilled that I've suddenly become cool to my kids, because we intersect on this, right? So I have millennial children, and they just think it's so cool that I'm into ESG investing, and so it's a nice intersection, because, like you said, they don't yet have the wealth to move the needle the way that boomer women and boomers in general do. Scott, I want to turn for a minute to you because there's been a controversial piece of legislation recently. I'll call it midnight legislation during the Trump presidency, where the Department of Labor issued a new regulation that made it more difficult for pension funds and 401ks and other kinds of retirement vehicles to actually house ESG investments. The word is now that Biden has this on his list of issues to review, and that they might actually reverse that Department of Labor ruling. And this is important because for all working people, millennials, anyone who's got a 401k, if they want to exert any influence over their investments and align their investments with their values, they've got to be able to have ESG options. So what do you think about that from your point of view? Scott.
Oh, I'm sorry. I thought you said Kara.
Yeah, no, sorry.
I misunderstood you. So basically, this is one of those DOL final rulings, and it was on how fiduciaries and investment managers select plan investments. They ended up removing ESG from and some other concepts because there were no, as we're all finding, uniform definitions. That in the language of the DOL, investment decision making from a fiduciary perspective needs to be based on pecuniary factors, and they saw sort of ESG's lack of or vagueness maybe as non-pecuniary factors in. So that they set that aside, and I think and I hope that the Biden administration will just turn that back around. So I think that the factor that will be a bigger role is the kind of thing we've been talking about here, that fundamental analysis and some of those things will play into and become part of how you look at a quote ESG opportunity. So I just don't think it's going to be that long-lived of a final rule.
Yeah, I kind of agree. I think 95% of comments surrounding that rule from the industry itself was just violently negative, and it passed anyway. I feel like it's probably going to be reversed, and I think that's really important for working Americans. Anybody with a 401k can invest in an ESG fund if it's available. And for the benefit of our audience, the term pecuniary means of or related to financial issues. So basically, the Department of Labor was saying that if you invest in any product or investment that is not purely financial, that you're sort of neglecting your fiduciary duty. But as Jules pointed out, and I think we would all agree, there have been tons and tons of meta studies even done that show that ESG investing either meets or exceeds non-ESG portfolio returns 90% of the time. And even BlackRock is saying that it reduces risk. So that study just seemed like it really wasn't well-founded. And so my hope is that it'll be reversed, because I would like to see our millennials and everybody in between being able to invest in ESG and leverage their voice. So I would think most of us agree on that.
Yeah.
So switching topics a little bit, Kara, I know this is something that's real near and dear to your heart, and you mentioned it when you first introduced yourself, but this concept of financial wellness, a more holistic approach related to wellness. Tell me how impact investing at your firm fits in with financial wellness.
Right. So in addition to financial security, we believe financial wellness or well-being is the alignment of one's resources with what you care about the most. And so to me, it fits hand in glove with impact investing. And yes, it is very nuanced, because what matters to the four of us here, we'd all have different ESG or impact portfolios. The reason we, I think working with, our wealthy clients, the majority have enough. They live in abundance and we've helped get them there. But what is most meaningful, and helping people define, their legacy, and how is it that you really want to make a difference, whether it's through philanthropy, your actions, or past, legacy, estate planning, however it is that you want to be in the world. We love that we can then take the next level. Our tagline at Brighton Jones is helping clients live richer lives, and we all know it's not about money, because we get to see that that state where you've got sufficient money, but unless you're aligned with what really matters to you and that sense of purpose and giving back, it falls a little bit flat. There was a question about renewables, and for example, we not only for example, if one of your clients, I think it was Chris, asked if renewable investing is important to you, we not offer that investing, but love that we can report back some metrics so that make it meaningful. Here's just a couple with one of our funds: 2.4 billion kilowatts of clean energy generated, 12.3 million kilowatts of energy conserved, 4.3 million metric tons of carbon emissions reduced. So that's the kind of impact metrics that just tie it all back.
Yeah, and just helps you feel good, like you're living a purposeful, values-driven life in every aspect of your life.
Well, I think she brings up a great point, kind of what we started with, this idea of outcome-oriented. People aren't going to just embrace ESG because it says environmental, social, and governance. They're going to embrace it because there's facts behind the analysis. And I think it's going to be a period of time before the general public really holds on to this, but these kinds of studies and the output or the outcomes that come from them, I think will go a long way to advancing it.
Yeah, agreed. It's not a cosmetic facelift. It actually has to make a difference, and we're going to have, just like in philanthropy, we're just going to have to see results. And I think, we can point to many instances where we've seen, for example, shareholder resolutions that have resulted in, yes, they put a woman on the board. Yes, they gave paternity leave. Yes, they did this. Generally speaking, companies want to do what the people want, right? Where they're consumers, where they're investors. It's a matter of vocalizing and asking for change often. And so the hope is that if enough of us do that together, that we'll see some meaningful change. And I think that will come to pass. So in the investment industry, and we have, let's see, about 10 minutes. So I really want to spend some good time on these last two questions because I think that they're really important. The first is that from a portfolio point of view, if we can argue that you're getting comparable returns at lower risk, why wouldn't every portfolio be an ESG portfolio? And many people in the industry that I know, for example, think that this is going to happen, that it's inevitable that this will be yet another factor because ESG investing is actually just good investing. I'd love to hear all of your thoughts on this, where you think this is going. And Cara, maybe we can start with you.
Sure. Yeah, I think you identified one of the pieces, and that is if for investors that are already in the market, they have huge capital gains, and the idea of getting out poses a big tax burden. Perceivably, there are ways around, whether it's through IRAs or tax loss harvesting or new dollars, and slowly reallocating. Those are just a couple simple solutions. But I think there's just a lot of still myths to be debunked, and not only on the concessionary piece, the association maybe politically not fully understanding what's under the hood within funds, and that you can get market-like returns, if not outperform. What's another, some other pushback? Oh, recently I've just heard that, it's just that there's a tilt to large cap in those portfolios. There's really no value in the sustainable fund. So I think it's, I think it's education and really opening up the conversation to hear what people care about and debunking some of the myths. And it's just, we talked about this earlier too, working with the advisors to start asking the questions earlier on. Even in our process, we've realized it's too late once you're in planning. It's too late just to like throw it in and say, oh, and what about an ESG tilt? Let's start those conversations, from the beginning to assess. And that's okay if someone absolutely is adamant, even if, they just don't really care and doesn't make a difference to them, that's totally fine. But we'd love to open that up and hear philosophically, what people's values are. And maybe the whole portfolio can't attain pure impact or ESG, tips, for example, that's a challenging class to achieve. But, and it doesn't have to be pure. It doesn't have to be 100%. I guess that's another thing to remember.
I think too, there are those naysayers out there, and they rightly point to a lot of greenwashing. I mean, when ESG started to become more popular, it was very easy for companies to slap on a ESG title, even if they weren't actually doing something material. And so I think we've gotten better at that with the rating agencies and some of the SASB comments that have been made, but I do think that, we're going to have to move more towards standardization and transparency on the ESG front, and that'll go a long way. What about you, Jules? How do you feel about this?
I agree with a lot of Kara's points, and I think that the driver is going to be education at this point. And I really do think that if more people know about this, they will want to do it. It's one of those like, oh, how did I not know that this existed? And it's a light bulb. And once it goes off, you kind of can't unsee it. Yeah. So I think that will continue to drive both clients wanting to invest more in this, but also funds and managers, including ESG factors, including non-financial factors into analysis. And it's so interesting. We were just talking about the DOL ruling, and that their stance is that as a fiduciary, it's just about financial returns. But I really think that's so backwards. I think as a fiduciary, it's our imperative to actually look at the entire risk spectrum, and that includes more than just financial exposure. It includes other real risks that have effects on companies and long-term performance. So that's my take.
That's the quantifiable way to look at it for those naysayers that are, think it's more of a qualitative approach. I'd point everyone to the Bank of America Merrill Lynch study in 2019 that showed ESG factors were the best indicator for volatility and bankruptcies. And by investing in those lower ESG rated companies had the highest correlation to bankruptcies. Risk mitigation piece is so often overlooked, and that's something that we can quantify.
And we can look to companies like Volkswagen and Equifax, and I mean, there's been so many where the rating agencies have actually downgraded these companies 1 to 2 years before the scandals hit, and billions of dollars of shareholder value was lost, which if you had been an ESG investor, you potentially wouldn't have been in those stocks. I'm sorry, Scott, go ahead.
No, I was just going to say again on our side of the practice, investment policy statements really drive the overall approach of the underlying organization. So in that, beliefs drive practice, and if the beliefs of the organization are to, I don't know who said it, but maybe you can't go 100% with every investment. So you have to sort of intertwine your beliefs with, the practicality of investing. And when we write, and we're writing more and more now, policies that include ESG and investment policy statements, we're being more general. We're saying things like, to the extent practical, the organization will strive to, and then talk about ESG as a definition, so that's memorialized inside the statement, and it allows the fiduciaries around the table and the investment team and the investment consultant to go out and sort of seek those best practices and drive those beliefs or appeal to those beliefs.
Yeah, I agree. We can't let perfection be the enemy of progress. In other words, like you got to just get started, and we're going to walk in the fog and see a little further, but you're making progress.
Exactly.
So we only have about 3 minutes, and this last question I think is so pivotal. Using values-based investing as a business tool. I know that we at Stearns, as I mentioned, had only traditional portfolios, and we actually did a survey and found that 50% of our clients, if given the opportunity, would do ESG investing. And once we explained it to them, they're opting to do it. And so how do you guys feel about ESG investing as a way to drive AUM and to make relationships stickier? Jules, let's start with you.
Yeah, I just think it 100% makes the relationships fuller, makes the relationships stickier. I mean, it shows clients and it shows prospects also that we have the ability to look beyond the returns, beyond the financial statements, beyond the tax discussions, et cetera, all of which is critical. But at the end of the day, we're working with people. And we know them, and we want to help them to achieve their goals beyond financial goals. So it absolutely makes the relationship more fulfilling, more interesting. I mean, I'm constantly in communication with clients who are doing impact investing. They're sending me an article that they saw, or they want to talk about an exciting company. There's just a lot of opportunity for engagement. And then in terms of business development, we are absolutely seeing an increase in prospective clients who are asking about ESG, asking about impact investing.
Yeah.
So it's important to have a grip on it now for the future of our firm.
Yeah, agree. Cara, what about you guys?
Yeah, when I think about our retention rate, what's keeping clients, and we're fortunate, we have about 98% client retention rate, and it's not ESG. I definitely wouldn't point to just that. That is a factor, but I think, like Jules mentioned, it's about getting to know your clients on a deeper level, deepening the relationships, really understanding them, building communities that are of, back to the meaning piece and purpose. What we're finding is these communities we're building around social inequity, or we've got a Women Living a Richer Life group. That's where it becomes meaningful and bringing people together on the causes that matter. It's less about, because you do ESG investing, we're going to stay with you. But around generating new attention, I do know, having worked all the way from BlackRock through to where I am now, if you're not offering an ESG option, I know that can certainly turn away prospective investors.
Mm-hmm.
I'll just leave it there because we've got 1 minute.
Yeah, and Scott, I want to give you a chance. I'm sorry, we're kind of short on time, but please comment.
I'll just say that our clients are already there. They're interested. And if CapTrust didn't have expertise and knowledge today in this area, we wouldn't be very credible. So I think as these factors and concepts grow, all of our firms should be prepared to sort of leverage these concepts into action or risk falling behind.
Yeah, agree completely. It is shocking, though, how few RIA firms actually offer this if you look at it as a whole. And so I think the rise of the retail investor is, their demand is going to drive the supply. We're on time, Sarah.
Wonderful. No, thank you. That was fantastic. I appreciate your comments and your discussion. It was really enlightening to hear and to learn from you. So I wanted to thank all of you for joining us for the RIA ESG Summit. That was our last panel of today. Thank you to all the panelists today for sharing their expertise. And thank you to our sponsors, Amundi, Invesco, John Hancock Investment Management, Nuveen, Schroders, the TIFIN Group, Trillium Asset Management, and Vanguard for their expertise and their support throughout the day. And thank you to you for your participation and your questions that you posed to our panelists. So if you would like to cash in on the CFP credits, so to speak, from today, make sure you email Paulina@IC Summits. And if you would like to join us again, if you enjoyed today and want to hear more, our next event is March 23rd and 24th. That's the RIA Advisory and Investments Summit. That will be a 2-day event made up of investment decision makers from really fantastic firms. So we invite you to join us for that. And then we also have a Millennial Money Management Symposium, a Retirement Symposium, and Emerging Advisor Symposiums coming up this year before our live event, hopefully this summer. But before that, we will be continuing the conversation in the virtual happy hour. So join us again there. It's the same link. We'll put it in the chat, or the meeting ID and password are up there. Join us there with a drink, hard or soft. Our panelists should meet us there. And behalf on the entire team at Portfolio Summits, thank you very much. We'll see you in the networking or on March 23rd. Have a great day.
Bye, everyone.
use